let's start with the revision of miscellaneous provisions. Let's start with the revision of miscellaneous provisions chapter. First point is about the government companies. First of all, the definition of government companies, it is defined in section 2 clause 45. It is defined in section 2 clause 45, which says that if there is any particular company in which, just try to recollect along with me, if there is any such company in which at least 51% of the share capital, both equity as well as preference, if this is held by either by central government, or it is held by state government, or it is held jointly by both, then in that case such a company will be treated as a government company, and every subsidiary of a government company will be deemed to be a government company. Right? Generally we take 51% of the paid up share capital. Generally we take 51% of the paid up share capital for determining whether it is a government company or not. But if differential voting rights, shares with differential voting rights have been issued, then we are supposed to take at least 51% of the total voting power. At least that much voting power should be there with central government, state government, or jointly by both. Then in such case that particular company is treated as a government company as per the Companies Act section 2 clause 45. Okay, now we just have to study two provisions about the government companies here. One is section number 394 and the other one is section number 395, both of which are going to talk about the annual reports only. Okay, first of all, annual report of a government company. Okay, annual report of a government company. Now, whenever in a, I am making three bifurcations, okay, imaginary three bifurcations I am making. First of all, it is such a government company where only central government is having the holding. Okay, where only central government is having the holding, then in that case, CG is going to prepare this annual report, which is a booklet consisting of your annual report, audit report, and the CAG's comment. Right, CAG's comment. All these three things, cumulatively we can even call it as an annual report or a booklet of the annual report. This will be prepared by the central government only, because now in the first bifurcation that I have made, here the shareholding is only of the central government. So central government is going to prepare this within 3 months from the date of AGM. Okay, within 3 months from the date of AGM, central government is going to prepare it and it is going to present before both the houses of Parliament. Okay, preparation has to be done by the CG and the presentation also has to be done by the CG before both the houses of Parliament. Right, going on to the next case where CG as well as SG are the members. Here the report will be prepared by the CG only. Okay, preparation work is still to be done by the CG only, but laying down will be done respectively. Example, CG is going to lay down before both the houses of Parliament. Central government is going to lay down before both the houses of Parliament, and state government is going to lay down before the state legislature. Okay, it is going to lay down before the state legislature, but in both the cases, it is the same common report which has been prepared by the central government. Okay, and the last case, that is section number 395, where only central government or one or more central governments are the members in this particular government company, then obviously the report has to be prepared. A single report will be prepared by the state government. It will be prepared by the state government combined mutually, and then it will be placed before the state legislatures respectively. Before respective states legislature, it will be presented separately, and even this will be prepared within 3 months from the date of AGM, and it has to be laid down as soon as possible. Okay, these points 394 and 395 is even applicable. It is even applicable to the cases where the government company is into liquidation. Okay, even if the government company is into liquidation, then also these provisions are applicable. Means same way the report has to be prepared, same way the report has to be laid down. This was all about the first part. That is your government companies. Going on to the next one, which was talking about the miscellaneous punishments and the penalties, etc., in which we just studied two of them. First one is section number 447 and the second one is section number 450. 447 is universal section, which you already know, which talks about punishment for fraud. Okay, so first of all, we have to quantify this particular fraud. Okay, first of all, we are going to quantify this fraud, where they say that if any person who is involved in the fraud, okay, any person who is involved in the fraud, and if he has done a fraud of at least a particular limit. How much is that limit? At least rupees 10 lakhs or 1% of the turnover of the company, whichever is lower. Okay, this is the limit, 10 lakh rupees or 1% of the turnover of the company, whichever is lower. This is my limit. If the amount involved in the fraud is at least this much or more than this, then in that case, that particular person will be punishable with imprisonment and fine. That person will be punishable with imprisonment and fine. Imprisonment, which can range between 6 months to 10 years, and fine, which can range from amount which was involved in the fraud and which can go up to 3 times, the amount involved in the fraud. But just remember, this is a non-compoundable offense, and that's why the word used here is and in between. Okay, and suppose if this big fraud involves public interest also, okay, if it has affected public interest also, then in that case the minimum tenure of imprisonment would be 3 years instead of 6 months. Okay, just now I told you that it will range between 6 months to 10 years. But if it involves public interest, then instead of 6 months, it will be 3 years. 3 years to 10 years will be the minimum imprisonment, and the fine will remain the same. That is the amount involved in the fraud, which can go up to 3 times the amount involved in the fraud. Okay, then next one, if suppose the amount involved in the fraud is lesser than the limit. Amount involved in the fraud is lesser than that limit. Ma'am, what was that limit? 10 lakhs or 1% of the turnover of the company, whichever is lower. If the fraud is of a smaller amount, that is, it is even lesser than the limit, then in that case, it is a compoundable offense. So here that person will be punishable for imprisonment up to 5 years or fine up to rupees 50 lakhs or both. Okay, so this becomes a compoundable offense, because here the word used here is or, and the imprisonment is not mandatory. Okay, but this one will be applicable. And it never involves public interest. Just try to understand here, the amount involved is small. Okay, the fraud amount is small, so the MCA assumes, your Ministry of Corporate Affairs assumes that here the amount involved the fraud involved here does not involve any public interest. Okay, then going on to the next one, that is section number 450, which was a residual punishment, which says that if in any provisions of the Companies Act, if any punishment is not mentioned, then the company and every defaulting officer of the company would be liable for a fine up to rupees 10,000, and in case of a continuing offense, it will be liable for fine up to rupees 1,000 per day, during which the contravention continues. So up to rupees 10,000 is a particular amount, and after a particular day also, if you are continuing with that particular offense, then it will be 1,000 rupees, right? Then going on, this was the second part. Total there are 6 parts in the chapter. So this was the second part, that is your punishment. Going on to the third one, which talks about your dormant company. Okay, dormant company is given in section number 455. Dormant company is explained in section number 455, where they say that if the company is formed for a future purpose. Okay, the company has been incorporated, but it has been formed for a future project. Then in that case, it can go and make an application to the ROC for getting the status of a dormant company, or alternatively, if the company is an inactive company. Then the company can go and make an application to the ROC for getting the status of a dormant company. Ma'am, what do you mean by the term inactive company? Inactive company means if the company is not doing any business, the company is not carrying on any business or operation, or it has not made any significant accounting transactions during the last 2 years, or the company has not filed its FS and annual returns during the last 2 years. Then as of now, suppose it is not doing any business or operation, it has not done any significant business transaction during the last 2 years, or it has not filed these documents, these returns, etc. during the last 2 years, then in that case, the company is deemed to be an inactive company. And if the company is deemed to be an inactive company, then it can go and make an application to the ROC for getting the status of a dormant company. But one thing important here is, see, when we go and make an application to the ROC, we have to use a form called as MSC1. Okay, we have to use a form called as MSC1, in which we are going to go and make an application to the ROC, and along with that we have to attach the SR, that is the special resolution passed by the members, or if we could not pass the resolution, but we have the consent of at least 3/4 of the shareholders, obviously in terms of rupees, that is in value, then in that case ROC will accept your application. ROC will check ROC will check whether you should be granted a status of a dormant company or not. Okay. Now, once the application reaches the ROC in form number MSC1, if ROC is satisfied, then it will grant you the status of a dormant company in a certificate in form number MSC2. Okay, in form number MSC2, it will grant you a certificate. Okay, once you are treated as a dormant company, then your name will be placed in the register of dormant company. Okay, now here too many compliances which were generally applicable to a normal company, those gets reduced in case of dormant company. But yes, following the minimum number of directors criteria, paying the annual fees, filing the dormant company return, some provisions are still applicable, but that then too it is too less in terms of compliances. If we talk, then it is too less as compared to a normal company. Okay, then every year this particular dormant company has to file a return of dormant company. Okay, it has to file a return of dormant company which is going to be filed within 30 days from the year end. Whenever the year is going to end, from that day within a period of 30 days. See, why 30 days? Because there are no transactions as such. Right, there are no significant accounting transactions as such, so that's why the time allowed here is too less. That is, within 30 days the company has to file the return of dormant company in form number MSC3. MSC1 was where we made an application. MSC2 was where they told that okay, you are a dormant company. MSC3 is the return for the dormant company, where you have to go and file this with the ROC every year within a period of 30 days from the end of the financial year. Okay, now till now we were simply going and making an application to the ROC that sir, please treat us as a dormant company. Similarly, if we haven't filed our FS or annual returns for the last 2 years, then ROC can also put our name in the register of dormant company after giving us a reasonable opportunity of being heard. Okay, suppose if you fail to make an application to the ROC for putting your name in the register of dormant company, then ROC can simply do that. ROC, if it thinks that you haven't filed your FS annual returns for the last 2 years, it can make an, it will give you an opportunity and it will put your name in the register of the dormant company. Okay, so now see, dormant company is such a company where there are actually no transactions, right? There are actually no significant transactions. So in that case, they are telling that the provision for rotation of directors are not to be made applicable here. Why? Because there is no need. The directors are actually not doing any work as of now here. So rotation of directors is not at all required here. Okay, in future, if any particular dormant company wants to come back, and get the status of an active company, now if it wants to start its own business or restart its business, etc., then in that case, it can again go and make an application in MSC4. Okay, it can again go and make an application in form number MSC4 to the ROC and satisfy the ROC that we want to start our business again. If ROC is satisfied that yes, okay, no problem, then ROC will grant you the status of an active company in MSC5. Okay, it will grant you the status of an active company in form number MSC5. MSC5, it will grant you the certificate, right? So in this way, from form number MSC1 to form number MSC5, this way you went from an active company to a dormant company, and then from a dormant company to an active company. And then the conclusion of this important note here is there should be no default done by the company. There should be no outstanding dues of the company, right? The company should not be a listed company. If these conditions are fulfilled, then only you can apply for the status of a dormant company. Otherwise, you cannot become a dormant company. Right? This was all about your dormant company. 3 out of 6 done. Okay, 3 out of 6 done. Now coming to Nidhi companies, that is your Nidhi section number 406 as well as some important pointers from the Nidhi rules. Okay, let's try to revise all the important pointers here. First of all, in case of a Nidhi company, Nidhi or a mutual benefit society, first of all, they have to get declared. Okay, once it is incorporated under the Companies Act, after that they have to be declared as a Nidhi or a mutual benefit society by the central government. Okay, central government will declare us as a Nidhi or central government will declare us as a mutual benefit society, and it will tell us that all the provisions of Nidhi will be applicable to you, or it will say that okay, all provisions are applicable except for these few. That is, it can grant you some exceptions, modifications, etc. also. Okay, and once you are declared as a Nidhi or a mutual benefit society, then it is placed before both the houses of, normally, whenever the central government passes a notification, it will be placed before both the houses of parliament for 30 days each. Right? Now listen, just try to understand here. Every Nidhi or every mutual benefit society which was existing under the old law, that is under section 620A of the Companies Act 1956, or any Nidhi which was incorporated in this 406 of the Companies Act, etc. To all these Nidhis, your Nidhi rules would become applicable. Okay, Nidhi rules would become applicable to every other Nidhi company or the mutual benefit society. Nidhi company is such a company which the main objective of which is it cultivates a habit of saving among its members. It asks its members to save some money so that they can lend that money to the Nidhi company, and Nidhi company can lend money to its needy members. Right, to its needy members, the Nidhi company can lend its money, and every time, just try to remember this, Nidhi company always works for the benefit of its members. It takes money from its members, it lends the money to its members. It provides other services also only to its members, and that's why we say that it works on the concept, or it works on the principles of mutual benefit. Okay, then next thing coming up there is, now a few important pointers about the incorporation of Nidhi company. Nidhi company, first of all, whenever it is incorporated, it is in form of a public company. So if it is a company, then in that case it should have a share capital. Compulsorily it should have only equity share capital, preference is not allowed. It should have a minimum share capital of at least rupees 5 lakhs. It should have at least 200 members at any point of time. At any point of time during the year, it should have 200 number of members. Its name should contain the word Nidhi Limited at the end so as to identify that this is a Nidhi company. It cannot engage itself into chit fund business. It cannot engage itself into any other finance business. It cannot engage itself into hire purchase finance business. It can get merged. It can get merged with another Nidhi company, but only after SR is passed and approval from the RD has been taken. Approval from the regional director has been taken. Nidhi company can give locker facility on rent to its members. But there is an important condition here, that is the rent that you are receiving from this locker facility, that should not exceed 20%. That should not exceed 20% of the total income. Okay, means this should not be a key activity. This should not be an key activity. Okay, it should have a net owned funds. Nidhi company should have net owned funds of at least rupees 10 lakhs. It should have net owned funds of at least rupees 10 lakhs. These are the 4 conditions which must be fulfilled within 1 year. They have given a buffer period that at least within a period of 1 year from the date of incorporation, these conditions must be fulfilled. First of all, 200 number of members. We are still given 1 year to fulfill this condition. Then net owned fund should be at least rupees 10 lakhs. Okay, then your ratio of equity to debt should be 1:20. Should be maximum 1:20. And then you should have some debt-free, unencumbered term deposits in your banks, etc., other than cooperative banks and the regional rural banks, of at least 10% of the total payable deposits. Okay, whatever is your liability side deposit into 10%, this much amount should be kept in your term deposits as a security. Okay. Then after that, this we have already done, that it cannot engage in itself into any other business like chit fund, etc. But yes, merger can be done, as I have marked that point as important. It can acquire any other company, it can get merged with any other company only after passing a SR and after taking the approval from the regional director. Right? Then another thing here is about the share capital. Another thing here is share capital. Generally they are telling that whenever a Nidhi company issues shares, right, we had just studied, it should have a paid up share capital of at least 5 lakhs, etc. Then its share face value should be of at least rupees 10. Okay, one share should be of at least rupees 10. Okay, and if Nidhi is issuing shares to any other members, then they are telling minimum 10 shares must be issued. Okay, see, what is their basic focus here is minimum rupees 100 value shares must be issued. Okay, so say for example, if the shares face value is 10, then at least 10 equity shares must be issued minimum. Okay, if the shares value is, say for example, 100, then even if you issue one share to that particular member, then that would suffice. But if there is any such member, who has put the money in our saving scheme, who has put the money in our RD scheme, then he should, even if he is given one share of 10 rupees each, that would be sufficient. Means 100 rupees requirement is not applicable here. 10 rupees share would be sufficient. Okay, then as we have already studied that there should be 200 members, right? At any point of time there should be 200 members in this Nidhi company. Deposits can be accepted in the name of minor, but minor cannot be a member, right? Our parents can give the deposits in name of minor child, but minor cannot directly become a member in the Nidhi company. Coming on to the directors, now since Nidhi is a company, it should have directors also. These directors should also be the members of Nidhi. If they are appointed at once, then they can hold office up to 10 consecutive years. There is no issue in that. Okay, up to, I'm not telling that it is fixed 10 years, but it can be any period up to 10 consecutive years. If they want to come back again in the company anytime, then in that case, after a cooling period of 2 years, they can come back in the company, right? Rotation of directors was not applicable in case of dormant company, but it would be normally applicable here also. Okay, DIN provisions would be applicable for director. The DIN provisions would be applicable here. Disqualification of director provisions would, so this everything would be applicable here because this is a normal company. This is an active company, right? Then going on to dividend. In case of dividend, Nidhi company, since it is having share capital, it can pay dividend, right? It can pay dividend of maximum 25%. It can pay dividend of maximum 25% or any higher sum as approved by the regional director. 25% or any higher sum as approved by the regional director, but there is one important clause here, or we can say there are three conditions which are to be fulfilled here. First of all, equivalent amount must be transferred in the general reserve as security. Okay, as a reserve, equivalent, whatever amount of dividend you are paying, equivalent amount must be transferred to the general reserve. Okay, second one, there should be no default in repayment of deposits or its interest, and it should comply with all the provisions relating to Nidhi. Then and only then it can pay the dividend. Okay, then and only then it can pay the dividend exceeding that particular percentage. Okay, going on to the next point, which is talking about the auditors. In case of Nidhi company, if an individual auditor is appointed, then his tenure will be 1 term of 5 years. Firm of auditors, 2 terms of 5 years. After that, if they want to get reappointed, there will be a cooling period of 2 years, and normally the auditor is going to submit his audit report, and in that there has to be a specific point, that all the provisions relating to Nidhi have been complied. Just like auditor is giving a certificate that all the provisions relating to Nidhi have been complied. Okay, and the last point is if Nidhi company fails to comply with any of the provisions, Nidhi company or its officers in default they will be liable to a punishment that is half of what we had studied in section 450. That is up to rupees 5,000, and in case of continuing offense, it will be up to rupees 500 per day, right? Going on to the next one, that is your registered valuers. Registered valuers, most important thing here is your section number 247, that is the act. Okay, that is the provisions of the act, where they say that if in a particular company, if the company wants to get its assets, liabilities, property, net worth, goodwill, if the company wants to get all securities, etc., whenever the company wants to get these things valued, then the company shall appoint an experienced and a qualified person called to be a registered valuer. And this appointment, this point which I am going to tell you now, this is super important. If in a company, if we want to appoint a registered valuer, then in that case, the appointment has to be done by an audit committee. If we have an audit committee in the company, and if we do not have an audit committee, then in that case, it will be done by the board of directors. Right now, it is the responsibility of the registered valuer. It will be the responsibility of the registered valuer to do it in a true manner, to do it by an impartial way, to do it by following all the relevant rules and regulations, to exercise due diligence. This is the responsibility of the registered valuer. He has to make sure that he complies with all these things. Okay, and one important point here is, as of now, he cannot do any valuation of any asset in which he was interested in the last 3 years. Okay, also the asset of which he is doing the valuation today, he cannot get interested in that particular asset in the next 3 years. So 3 years before, 3 years after, there should be no interest in any such asset of whose evaluation has been done. Right? If any of the provisions have been contravened, then normal penalty would be, normal punishment would be applicable. If he has done purposely to defraud the company, creditors, etc., then different punishment or grievous punishment will be applicable there. Right? And if he is convicted here, then he will have to refund back his remuneration, and he will have to compensate the people who have suffered the losses. Right? He will have to compensate the persons for the losses that has been suffered because of this particular registered value. Right? And the examination for this registered values, etc., is being conducted by the IBBI. Okay, this I had mentioned in the regular batch also. This is conducted by the IBBI. Right? So this was all about your registered values. This was all about your registered values, section number 247. And the last point which is coming up here is talking about the removal of name of the companies from the register. Okay, now here what are they telling? Everyone just concentrate here, last few sections here. Now in section number 248, ROC has the power to remove the name of the company on 4 grounds. Okay, ROC has the power to remove the name of the company from the register of the companies on 4 grounds. First of all, if the company had been incorporated, but for a period of 1 year it did not do any business. Okay, second one, if the company was an ongoing company, but all of a sudden it stopped for a period of 2 years, no business operations for the last 2 years, and the company did not even obtain the status of a dormant company, then the ROC will give me a show cause notice, and I'll have to reply within a period of 30 days. Right, next one is the subscribers to the MOA who said that we will pay the money for the shares, they did not pay the money within 180 days from the date of incorporation. Or if the ROC comes to know after physical verification that the object clause which was written in the MOA, that is different, and physically the company, whatever business the company is doing, that is altogether different. Then in such cases, if any of the one case is attracted, then the ROC has got the power that after giving us a reasonable opportunity of being heard, ROC can cancel the name of the company from the register of the company. Okay, in the first point, ROC was taking the steps. Similarly, even we, the company, can pass a special resolution, or it can take the consent of 75% of the members, and it can say that yes sir, a default has happened from our end, and if any of these grounds are applicable, then we can suo moto go and make an application to the ROC that please remove my name. Okay, that please remove my name from the register of companies. And if you are such a company, which is regulated by a special act, then in that case we have to take the approval from that regulatory authority also. Okay, now suo moto thing is not applicable to section 8 companies, because the provisions of section 8 company totally restrict this particular matter, that we cannot go and suo moto make an application for removal of name of the company. Then once all these things are done, there is a public notice which is given that either ROC is removing our name, or we are suo moto going and making an application to the ROC that our name be removed. Okay, this is given to the general public so that even they come to know. Maybe if there are any shareholders, maybe if there are any other creditors, etc., who are still not aware about this fact, even they will come to know that the name of the company will be removed from the register of the company. Okay, after the ROC has given us a reasonable opportunity of being heard, after there is a communication between us and the ROC, if ROC is satisfied that yes, removal is justified, then in that case ROC will straight away strike off our name from the register of the companies. It will issue a notification. Basically, central government does it. Central government, and below that we have the ROC itself. So ROC gets it done through the central government. Central government publishes this notice in the official gazette, and finally it is confirmed that yes, the name of the company will be striked off, and ultimately dissolution. Okay, basically winding up is going to happen, that is first liquidation is going to happen, and then dissolution is going to happen. But this does not relieve the directors from the liability which might arise in future. Okay, if there are any liabilities which can arise in the near future, the directors cannot say at that particular point of time that we are not liable. Okay, directors, managers, etc., officers in charge will still be liable. They will still be liable for any liabilities which arise in the near future. Right? Then there were 5 cases. Where we cannot go and make an application. Basically, it is an opposite thing of section 248 subsection 2. In 248.2, remember, we were going and making an application to the ROC that we want to remove our name. Now here they are telling that for a period of 3 months from a specific event, you cannot go and make an application to the ROC for removal of name. Okay, suppose if you have changed your name or if you have changed your address from one state to another, then wait for 3 months, then go and make an application. Okay, if you have disposed of majority of assets, but you say that you have done in good faith, or if you have done in ordinary course of business, then wait for 3 months, then only go and make an application. Or if there is a change, major change in the object clause, or if you have made an application for compromise or arrangement, that is internal external reconstruction, or if the company is already being wound up under Companies Act or under IBC, if already winding up proceedings have been initiated, then why to go and make an application here? Okay, let's wait for the conclusion there. So these were the 5 cases. Where you cannot go and make an application for a period of 3 months. If you still go and make an application, then either you will have to withdraw it or the ROC is going to reject it, and plus it is going to levy a punishment on you up to rupees 1 lakh. Okay, fine up to rupees 1 lakh. Fine, this punishment is to be remembered. Okay, this punishment is to be remembered. I have already star marked here. Punishment, fine up to rupees 1 lakh would be applicable there. Right, and once my name has been removed, suppose assuming continuation of section 248, that is the first section, assuming our name has been removed, then in that case my certificate of incorporation will become invalid, right? My business operations will have to cease to operate now, and later on if any person claims any liability, okay, if any person claims any money from the company, then the directors, managers, etc. would still be liable. They cannot get relief from the liability. That will be lifetime. Okay, that will be lifetime. And if you have made any application, if you have made any fraudulent application because you wanted to defraud the creditors, because you wanted to run away from them, because you did not want to pay the money to them, because you wanted to do window dressing before the creditors, you wanted to show that no, the company's position is very bad, and that's why you made an application for removal of name, then in that case, boss, this is treated as a fraud. This is treated as a fraud, and if it is treated as a fraud, then in that case, punishment under section 447, would be applicable. Okay, punishment under section 447 would be applicable. And going on to the last section, that is appeal to the tribunal. Okay, there were three ways in this case in appeal to the tribunal. First case is when any particular person is aggrieved because of this ROC's order of striking of the name. If any person is aggrieved and that person says that, sir, there were no grounds for removal of name, there was no ground of section 248 which was present, then to ROC removed our name, then in that case you can go and file an appeal before the tribunal within a period of 3 years. Okay, you can go and file an appeal within a period of 3 years before the tribunal, and if the tribunal is satisfied, it will order for restoring the name. Okay, that was one thing. Second case, if the ROC itself thinks, oh, there was a mistake done from my end. If the ROC himself thinks that there was a mistake done from my end, that I removed the name on some wrong information, then ROC suo moto can go and make an application before the tribunal that, sir, please restore the name. Okay, in the first point, it was any person other than ROC. In the second one, ROC itself realized its own mistake. So it is going and making an application. It is going and filing an appeal within a period of 3 years, or it is going and making an application basically. If the tribunal is satisfied, it will order the name to be restored. And once the tribunal's restoration order is out, then we have to go and submit it with the ROC. As usual, everything has to be submitted to the ROC within a period of 30 days. And the last cases where the company, the members of the company, where the creditors or the workmen, if they are aggrieved and if they convince the tribunal that, sir, our name was wrongfully struck, our company was into existence, the business was going on in a decent manner, and if the tribunal is satisfied, then in that case, if these people go and make an application within a period of 20 years from the striking of date, okay, or 20 years from the date when the order was published in the official gazette, within 20 years, if they go and make an application, then in that case, the tribunal can order for restoration, and the company will be sent back to the original position. Right, so 252 is a resort available against the ROC's order, in which we went and we filed an appeal to the tribunal. Okay, and with this we are done with the revision of the miscellaneous provisions. Let's start with the revision of compromises, arrangements and amalgamations. In this particular chapter, first of all, the chapter is going to range between section number 230 to section number 240. The chapter is between section number 230 to section 240, in which we are going to talk about the procedures, of internal reconstruction as well as your external reconstruction. External reconstruction meaning your mergers, amalgamations, takeovers, etc., and as well as your internal reconstruction, wherein the company does some compromise, wherein the company does some kind of arrangement with its members internally or with its creditors internally. The most important section in the chapter is section number 230, the very first section. Now, if suppose the company wants to do any compromise or arrangement, then that can be between the company and its members, it can be between the company and its creditors, right? So, whenever these people want to do any kind of arrangement, they'll have to go and make an application. To the tribunal along with the necessary documents. Okay, the broad three things in the necessary document is first one is the material facts about the company, important facts about the company. Then if the scheme includes any scheme for reduction of share capital, and if the scheme includes the details about the corporate debt restructuring, then all these three details have to be included in that particular document that you are submitting it to the tribunal. And then basically you are going and making an application to the tribunal for seeking their approval for calling the meeting. Okay, you are going and making an application to the tribunal so that the tribunal allows you to call a meeting for this particular compromise or arrangement. Okay, when it's a case of corporate debt restructuring, first of all, the scheme must be approved by at least 75% of the secured creditors. And in that, you have to also submit some extra 5 things, which is first one, the creditor's responsibility statement in CAA1. Then the availability of, then the liquidity report, which is to be submitted by the auditor. Then what about the position of other creditors? Are we going to protect their interest? Have we followed the RBI guidelines? If this thing involves your banks, etc., and the valuer's report. Okay, even these things are to be submitted. to the tribunal when you are seeking the approval from the tribunal for calling a meeting. For this particular purpose, if suppose the tribunal agrees, then it will allow you to call the meeting. If you want to call the meeting, then you'll have to give the notice. To every person. It will be the creditors, it will be the shareholders, it will be the debenture holders, all the members. You're going to give them the notice at their individual addresses. Okay, whatever is their individual addresses, you'll have to give the notice. Then you'll also advertise your notice by putting it on your company's website. You are going to put it on, you are going to give it to the SEBI for putting it on their website. You are going to give it to the recognized stock exchange wherever if your shares are listed. All this you are going to do for advertisement of your notice, so that everybody should come to know that our company is going to do this compromise or arrangement. Okay, whenever you are sending this notice to their individual addresses, you have to give some annexures also. Okay, the list is given here, you can just refer it. You have to give the annexure also. Example, you have to give the details about the scheme. You have to give the copy of the valuer's report. You are going to submit what is going to be the effect of this particular compromise or arrangement. Okay, you have to give it along with the notice. But when the notice is advertised on any website, obviously then it is not possible to give the annexures along. So then you can give a facility that you can collect these particular annexures from the registered office of the company, right? Then after that, once the notice is given, after that they can vote for this particular resolution, that is for this compromise arrangement. These people can vote. Okay. And if they want to raise any objections, then the objections can be raised. In case of shareholders, objections can be raised by at least those who are holding 10% of the shareholding. And in case of debt, it can be raised by those who are holding at least 5% of the total debt. Only then we are going to consider their objections. Otherwise, we can go ahead. Okay, also we are going to raise the objections from all our regulators. Okay, example, central government, ROC, income tax authorities, SEBI, Competition Commission of India, etc. We are also going to ask them to raise their objections within a period of 30 days. If they do not raise any objections within a period of 30 days, then we'll assume that okay, they do not have any objections. After that, we are going to call a meeting and then we are going to take the approval. And in the approval for this particular scheme, we are going to take a dual majority. Okay, dual majority. Dual majority means when we talk about the numbers, okay, number of people who are voting in the meeting, in that at least a simple majority of them should say yes for the meeting. Okay, and then once you get in terms of numbers, then you have to go in the value and you'll have to check at least the people who have said yes, are they holding at least 3/4 of the value? Are they holding at least 3/4 of the value of members or creditors who are voting in the meeting? Okay, in the regular batch, we have done a question on this. Also, when you go and try the question answers, you will get it there also. Once this dual majority thing has been done, after that it is assumed as if the scheme has been approved and the tribunal is going to pass. The tribunal is going to pass the final order, which will consist of the details of the scheme, that what is going to be the effect of this compromise or arrangement. Okay, example, what are to be done with the preference shareholders, what are to be done with the other creditors, the other small creditors, what are you going to issue shares with differential voting rights, what are you going to do with the dissenting shareholders, all those things, you know, whatever thing is supposed to be implemented now, all those will be written in this particular scheme and this will be approved by the tribunal. Okay, then even the auditor has to give a statement that yes, the accounting treatment has been given as per the respective accounting standard as per section number 133. Even that is important. And the tribunal's order has to be filed with the ROC. Just like every important document, we file it with the ROC. Similarly, here also this particular tribunal's order, we are going to file it with the ROC within 30 days so that the ROC can register this particular scheme. Right now, when we were calling for the meeting of, if you remember, when we were doing this dual majority thing, etc., if at all any creditors meeting was required, and in that they have given a substitute that if suppose the tribunal, if not the tribunal, suppose if the creditors, if initially itself they have agreed by way of affidavit, okay, by way of affidavit, if that has been signed by at least 90% of the value of creditors that they are agreeable to the scheme, then they need not call for the meeting and take this dual majority of the creditors, etc. The meeting can be dispensed of. Okay, means you can dispense off with calling the meeting. There is no need to call the meeting because anyway here you have got 90% of the value of the creditors approved. Right? When it comes to buyback, suppose if your scheme contains any provision for buyback, then you have to follow section number 68. When your scheme consists of any reduction of share capital, then in that case, section 66 is not applicable, which talks about reduction of share capital, means the tribunal's order is going to override section number 66 in case of section number 230. If suppose an unlisted company is taking over any listed company, then in that case, this company automatically does not become a listed company. It will have to go and make an application for this listed. Right? And in the entire section, wherever we use the term tribunal, if the compromise or arrangement is happening of a government company, we are, instead of tribunal, the term that we are going to use, that will be the central government. Means everything will be done by the central government like it was done by the tribunal in your section number 230. Okay, once the scheme is approved, in section number 230, as we just studied now, once the tribunal or the central government, as the case may be, once they approve the scheme, after that they have all the powers to supervise the implementation, whether the implementation is done properly or not, and they can also give directions that okay, do implementation in this way, don't do this, do that, etc. The supervision and the directions can be done by the tribunal or the CG, as the case may be. And if at any time, if the tribunal thinks that no, this is not at all workable, if the tribunal or the central government thinks that no, this is not at all workable, then in that case it can simply order for winding up. See, internal reconstruction is one such way where we try to revive the company, where we have already decided that we don't want to close the company, but we want to revive this particular company. If that does not work, then the last option that we have got, that is your winding up. Then the tribunal can order for winding up in the section number 231. Okay, going on to the next section, that is section number 232, which is talking about mergers and amalgamation. Whenever any particular company wants to do any merger or amalgamation, which includes any transfer of property, then that can be done. Again, we'll have to, go to the tribunal. We'll have to take the approval from the tribunal. We'll have to give, just like section 230 subsection 3 to 230 subsection 6, those provisions will be applicable. That is, we are going to give individual notices to everyone. We are going to do the advertisement of a notice. We are going to tell them to raise objections. Those 5% and 10% people, we are going to tell them to raise objections. We are going to tell the regulators to raise objections within a period of 30 days. And then we are going to take a dual majority. If it is approved by way of dual majority, then the tribunal's order for merger and amalgamation is full and final. Right, in this, one extra thing that gets incorporated here is that whenever you were giving this particular notice, okay, whenever you were giving this particular notice, advertisement of notice, etc., at that time you also have to intimate about the share exchange ratio that you would have adopted. Right, the draft scheme of merger and amalgamation that you would have adopted, the exchange ratio, supplementary accounts have to be attached if your accounts are 6 months older. Right, all these, there are some extra documents, that you have to attach along with the notice, because see, in case of merger and amalgamation, what will the shareholders see first? They will first see that how much is the exchange ratio, how many new shares are they going to get instead of the old shares they are holding. So those respective things are to be attached along with the notice. Right, once all this dual majority thing is done, then the order of the tribunal is finalized. Tribunal will say that, okay, now the assets can be transferred, liability can be transferred, employees can be transferred, legal proceedings can be transferred, any charge which was there in the old company, that will be transferred. Right, then after that, what is to be done with the dissenting shareholders, how to pay them, when to pay them, all these things will be decided by the tribunal, and it will be documented by the tribunal in the order. Right, similarly here also, suppose if, just like I mentioned in the previous section, in section 230, if section 230 consists of a scheme of merger or amalgamation, then in that case, if the taking over company, okay, the company which is taking over another company, I mentioned it in already section number 230, if the purchasing company is an unlisted company and the selling company is a listed company, then automatically the purchasing company does not become a listed company. It will have to go as per the process and it will have to get itself listed. Then ma'am, what to do with the unlisted company? What to do with the dissenting shareholders? In case of dissenting shareholders, you'll have to pay them the amount, the predetermined amount or the amount which is determined by the valuer will have to pay them. And if at all that company was a listed company, if at all that selling company was a listed company, then we'll have to pay at least that much amount which is determined by the SEBI. Okay ma'am, why SEBI has come into picture here? Because here the selling company was a listed company, and if selling company is a listed company, then maximum things will be regulated by the SEBI. Similarly, in case of fees on the authorized share capital, now since we are going to issue more shares, maybe it can so happen that we'll have to increase our authorized share capital also. If we want to increase our authorized share capital, then in that case, we'll have to pay some fees to the ROC, to the central government, etc. Then they are telling that whatever fees was paid by the selling company, then that can be set off. Okay, that can be set off here, and you can take the credit of that particular amount. And here also the auditor will have to certify that all the effect of the accounting standards or the relevant Ind AS, whatever is applicable, that has been given as per section number 133. And again, just like your section number 230, here also once the tribunal passes the final order, we are going to go and submit. It to the ROC within a period of 30 days, and we are going to fix a particular date. And that date will be dated as a date as if on this date the amalgamation and merger was done. See, amalgamation or merger is a big process. Okay, so we cannot write a range of the dates that from 1st April to 31st March the amalgamation was done. We have to choose a specific date. We have to decide a specific date that yes, on this particular date my merger or amalgamation was done. Right, and then every year till this entire scheme is implemented, every year within a period of 210 days from the end of the year. Okay, this is important from MCQ point of view. I told in the regular lecture also, within a period of 210 days from the end of the year, you have to file a statement of compliance that all the compliance of the scheme has been done properly. Right, and in this also, in this case of merger amalgamation also, wherever the term tribunal was used, basically tribunal was coming into picture for supervising everything, for giving the approvals. So in case of government company, everything will be handled by the central government. So 230 was a general section which was talking about compromise or arrangement. 231 was talking about supervision and implementation. 232 was talking about merger and amalgamation. 233 is a specific section which is going to talk about merger or amalgamation in certain cases where there is a merger or amalgamation between two or more small companies. when there is a merger of or amalgamation of holding company and wholly owned subsidiary company, then they can make use of the section number 233, but there is a particular process which is applicable for that. First of all, we are irrespective companies, okay, both the companies will issue the proposed scheme to the ROC, to the official liquidator, and all those people who can be affected because of the scheme, and it will tell them to raise any objections, etc., within a period of 30 days. Okay, after that, once they raise the objections, we are going to consider their objections, and then the scheme will be approved by shareholders who are holding at least 90% of the total number of shares. Okay, once respectively the scheme is approved by the shareholders of the respective company, then we are going to file a statement of solvency with the ROC. Both the companies are going to file the statement of solvency with the ROC that even after this merger or amalgamation, we are going to be a solvent company only, or our financial position will be well enough, good enough. After that, we are going to call the meeting of the creditors by giving them at least 21 days notice in writing, and then in the creditors meeting also it should be approved by at least 90% of the value of the creditors. Okay, this is one such level basically where your scheme gets approved at least in-house. Okay, at least in-house the scheme gets approved. After that, we are going to go and, okay, once the creditors meeting is done and it is approved, then within 7 days we are going to go and file this particular scheme with the CG, ROC and the official liquidator in form number CAA11. Okay, if ROC and the official liquidator are satisfied, then well and good, the scheme gets approved immediately. If they are not satisfied, then they can raise objections before the central government. Okay, they can raise the objections before the central government within a period of 30 days. If central government thinks that yes, the objection is sustainable, means the objection of ROC and the official liquidator is sustainable, then central government will take this matter before the tribunal. Okay, it will take the matter before the tribunal within a period of 60 days from the date of filing the CAA11. Right, from 60 days from the date of filing CAA11, it will take the matter to the tribunal, and now finally the tribunal is going to decide whether it should be approved under 233 only, as you had told me here, whether it should be approved in 233 only, or whether it should be taken under section 232, that is the general section. Okay, and after that, suppose now assuming if the scheme is approved, okay, assuming if the scheme is approved, then after that the copy will be sent to everyone. Okay, dissolution of the selling company is going to happen, transfer of assets, liabilities, etc. is going to happen, legal proceedings will get transferred. Again, that point of authorized share capital fees, that set of thing, that same provision will become applicable here also. Okay, the most important thing here is the two companies about which we spoke, that is the small companies and the holding and the wholly owned subsidiary company. Basically, those two companies have an option whether they want to go for fast track merger under section 233 or whether they want to go under the normal merger and amalgamation procedures under section 232. So basically there is no hard and fast rule for these two companies to go under 233 only or to go under 232 only. Right? They can choose depending upon the subjective circumstances which exist in every company. On those basis they can choose that they want to go under which section. Right, then going on to the next one, that is section number 234, which talks about merger and amalgamation with any foreign company. Okay, if an Indian company is getting merged, or if a foreign company is getting merged with an Indian company, right, here foreign company means any company which has been incorporated outside India, irrespective of its place of business. Okay, we don't have to see the definition of 242 which we had seen in the second chapter here. Right, but here foreign company means any company which has been incorporated outside India. Okay, if suppose our Indian company is getting merged with that, or if suppose a foreign company is getting merged with an Indian company, then in that case three things are important here. First of all, CG approval must be taken. Right, CG rules must be complied. RBI approval must be taken. And then they are talking about the consideration. The consideration can be in form of cash, the consideration can be in form of depository receipts also. Okay, all the rules as specified by the central government, would be applicable. Going on to the next section, that is section number 235. For section number 235, section 235 is very simple section, very simple section. 235 talks about the scheme whenever any transfer of shares happen. Okay, say for example, whenever a particular company is acquiring another company. Okay, whenever a purchasing company is acquiring the selling company, can I say the purchasing company will have to give the offer to the shareholders of the selling company, because now the ultimate people who would be affected here is the shareholders of the selling company. Their shares of the selling company will become of zero value and they are going to get new shares now. So first of all, we are going to give the offer. Okay, this purchasing company is going to give the offer to all the shareholders of the selling company. Okay, it is going to give the offer to all the shareholders of the selling company, and it will give 4 months time period to approve this particular exchange ratio. Okay, and within this period of 4 months, at least 90% of the value of shareholders must be agreeable to the fact that yes, they are okay with this particular exchange ratio. Okay, now at the end of 4 months, suppose if we get at least 90% of the approval. See, if we do not get 90% of the approval, then in that case we'll have to prepare a new scheme. But assume if we get 90% of the approval, then in that case, for the next 2 months, we are also going to give more time, more 2 months time we are going to give to the dissenting shareholders, that we give you more 2 months time to accept our scheme. Okay, 2 months time, 2 months extra time. See, 4 months was given common for everyone to accept the scheme. In this 4 months, 90% assume they have accepted the scheme. But still there may be some shareholders who are still not agreeable to this particular exchange ratio. So we give them extra 2 months. Okay, take more 2 months and then agree to the scheme. If they do not agree again within a period of 2 months, then within the next 1 month, we are going to acquire their shares. Okay, within the next 1 month, we are going to acquire their shares. We are going to register their shares. Okay, we are going to basically compulsorily acquire their shares, and then we are going to pay off the money by putting the money in a separate bank account. Okay, the day when we acquire their shares, we have to immediately transfer the money for their shares. They are obviously going to get the consideration. We are going to transfer their consideration in a special bank account, in a separate bank account, and from that separate bank account, it will be paid to them within a period of 6 days. So this is the treatment. That is happening. With these particular dissenting shareholders. Okay. Going on to the next section, which talks about purchase of minority shareholding. Okay, which talks about purchase of minority shareholding. Say for example, if there is a particular group of shareholders who are holding at least 90% of the issued share capital. Now they already know that major decision making powers is in their hand only, because if we want to pass SR also, they can pass. If they want to take any important decisions, they can take, etc. So if there is a particular group of shareholders who are holding at least 90% of the issued share capital, they can give a proposal to the minority shareholders. That we would like to acquire your holding also. Okay, or alternatively, even the minority shareholders can go and make a proposal to the majority ones that okay, you can acquire our shares. Okay, anyway, we do not have any stand in the company, you can acquire our shares. Right? In this case, this particular process can be done. This process can be done as per the provisions of section 236 here. The valuations, etc. for the value of shares will be done. This will be done. The valuation, etc. will be done by the registered valuer, as we have already studied in section number 247. That particular person is going to do the valuation of these shares. Okay, so the consideration will be paid by the majority to the minority, and shares will be given by the minority to the majority. And then once this is decided, the money will be transferred by the majority in a separate bank account, and it has to be paid within a period of 60 days. Okay, it should be paid. The disbursement should happen within a period of 60 days. The day when the shares are acquired. Okay, the day when the majority gets the shares, from that day within a period of 60 days, the disbursement should happen. If not done within a period of 60 days, then it can be done within a period of 1 year. Okay, it's not 60 days plus 1 year, it is 1 year including this period of 60 days. Means we can get an extension. Of total period of 1 year including this original period of 60 days. Right? Similarly, at the time of negotiation, in case of minorities, if there is a majority, that is a particular person is holding at least 75% of the Minority share capital. See, majority was holding 90%, at least 90%. Suppose if in the minority we have 10%, in that 10% also someone is holding at least 75%. Then in that case, that particular person can have a good bargain that, okay, I can give you the shares if you give me so and so extra amount. So whatever extra consideration is received by this particular person, that will be shared amongst all the minorities. Not only with this big minority, it will be shared amongst all the minorities on pro rata basis. Okay, I have given an example here. You can just refer this example once. So if suppose any minority person is negotiating, okay, if any minority person is negotiating here, then that particular consideration will be shared among all the minority shareholders, right? That will be shared among all the minority shareholders. Going on to the next section, which talks about section number 237, which talks about merger or amalgamation by the central government in public interest. Merger or amalgamation by the central government in public interest, if CG is of the opinion, okay, if CG is of the opinion here, if CG is of the opinion that amalgamation should be done in public interest, then in that case, central government will prepare the scheme, including the assessment, and it is going to give to both the companies. Okay, CG is going to wait, CG should wait for a period of at least 2 months. CG should wait for a period of at least 2 months for considering the objections and to decide on that particular thing. If CG thinks that something should be changed, then CG is going to change that in the scheme. And then CG is going to put the scheme including the assessment, that is including the calculation for the exchange ratio, it is going to publish it in the official gazette. Right, if any person, if any member of the selling companies agree with this particular calculation, then they can go and file an appeal before the tribunal within a period of 30 days. Once the decision of tribunal is out, okay, once the decision of tribunal is out, that is full and final, and then only CJ will publish the final scheme in the official gazette. And then only the merger amalgamation can happen, that is transfer of assets, liabilities, legal proceedings, etc. Only after that it can happen. Right, so this was the procedure. This was the procedure applicable for merger or amalgamation, which is done by the central government in public interest. Then next section, section number 238. Section number 238, which says that when you were giving an offer, in section number 235, that is this one, 235. Remember when you were giving 4 months time plus extra 2 months time, etc. Before doing this, before giving the offer to the shareholders, you have to make sure that first of all your scheme is proper. It should contain the full exchange ratio details. It should contain a good offer for the shareholders. It should be appealing. I had told you this word. It should be appealing. It should be attractive, and it should contain a recommendation that yes, the scheme is a very good scheme. Right, it should be written. It should be written in that particular offer that even if the amalgamation etc. happens, then the necessary cash will be available for payment to the shareholders, if any. Right, then this particular scheme has to be registered. This particular scheme has to be registered with the ROC. Means before giving it to the shareholders in section 235, before giving those 4 months time to the shareholders, before that you have to present it before the ROC for its registration. Okay, and if the ROC is not satisfied with this particular scheme, then the ROC will raise the objection within a period of ROC can raise an objection within a period of 30 days. And if you are aggrieved by the order of the ROC that why is it rejecting it, it should not reject our scheme, etc., then you can go and file an appeal to the NCLT. So basically, before giving the exchange ratio offer to the shareholders, first give it to the ROC, take their approval. If ROC is not satisfied, then appeal to the tribunal, and then whatever is the decision of the tribunal, on that basis only section 235 can become applicable. After that, section number 239. 239 says that whenever the company which was a selling company in case of merger or amalgamation, once it has been taken over, it leads to dissolution of the selling company. But what about the books of accounts, etc.? So they are telling that the books of accounts can be disposed of, no issues in that, but that can be disposed of only after taking the prior approval of the central government. Okay, once the central government allows you to dispose of, then only you can do it, and central government can appoint any person to do the inspection in the books of accounts to check whether any fraud etc. was not done earlier now. If central government is satisfied that okay, we cannot, there was no fraud done etc., if central government is satisfied relating to the fraud relating to the formation of the company, fraud relating to affairs of the company, if CG thinks that okay, there was nothing, the books of accounts etc. is very clean, okay, then in that case central government will allow you to dispose of the books of accounts. And then section 240 says that suppose if after amalgamation, in case of a selling company, if later on any liabilities arise, if any offenses etc., if something arises, then also the directors, officers, managers of the old company, they will still be liable, and they will have to pay for that, they will have to compensate for that particular liability. They cannot say that our company has been dissolved now. Their liability is going to be an ongoing liability. And the two case laws here from the old law, is, first one was, it was decided under your Companies Act 1956 that whenever you want to raise any objection regarding the exchange ratio, okay, whenever you want to raise any objection regarding the exchange ratio, then in that case, only if you have a good reason for raising an objection, then only you raise it before the court, otherwise the court is not going to consider it. Okay, you simply come and say that I have a problem that is not sustainable, but if you justify that why this exchange ratio is not sustainable, then only the court is going to interfere in the process, and it is going to allow that particular person to raise an objection. Basically, any baseless objections will not be considered by the court. And the second one is, just like earlier, all the valuations etc. were allowed to be done by the chartered accountants etc. Then if suppose the valuation has been done by the chartered accountants, and if it has been agreed by majority of the shareholders, then in that case the small group of shareholders or some number of shareholders cannot raise any objection, okay, or even if they raise any objection, but if it has been confirmed by the chartered accountants, if it has been agreed by majority of the shareholders, then their objection cannot be sustained, right? So this was all about your compromises, arrangements, amalgamation chapter. Whatever we have done in the revision, even if you do this much, it would be more than sufficient, considering the weightage of the chapter. Let's start with the super quick revision of winding up chapter. We are going to cover all the important sections. In this particular chapter. First of all, winding up is stretching from section number 270 to 365. But however, from these particular sections, from this particular range, some sections have been omitted. Some sections have been omitted by the MCA itself, that is, few sections have been deleted by the MCA, and then further from the filtered sections, some sections have been deleted by the ICAI also. Okay, now starting with section number 271. Starting with section, we are, as I already mentioned, we are going to do all the important sections which you have to remember on your exam day. Okay, since this is a super quick revision, so we are doing from the exam day point of view. So first of all, section number 271 states the cases. Section number 271 states the cases when the company can apply, or when the petition can be filed by any other person for winding up of a particular company. There are in all 5 cases where the petition for winding up can be filed. First of all, when the company itself has passed a special resolution and the company wants to wind up the company. Okay, when the company wants to wind up itself, basically at that time the company will pass a special resolution. That is one option available. Another thing, suppose if the company is acting against the interest of the country, against the sovereignty of the country, against the security of the country, or it is affecting the friendly relations of our country with another state, then in that case, there is no decency etc. when it is trading with some other country etc., then in that case, any person like your ROC or your central government or your state government can file a petition with the tribunal for winding up a particular company. or if the tribunal is of the opinion, okay, if the tribunal is of the opinion, okay, if the tribunal is of the opinion that the affairs of the company are not being managed properly, it is managed in a fraudulent manner, or it is going on in an unlawful purpose, or some unlawful work is going on, and it is better or it is proper to wind up the company, then in that case, the tribunal can wind up this particular company. If the company has not filed its FS and the FS or the annual returns for the last 5 consecutive years, okay, for the last 5 years it has not filed its FS or the annual returns, then in that case generally ROC will come to know about this. So ROC can file a petition with the tribunal for winding up of this particular company. And the last point is an etc. point, which says that if the tribunal thinks that it is just and fair, if it thinks that it is just and fair that the company should be wound up, then in that case the company can be wound up. These are the 5 cases. This is the most important answer here. These are the 5 cases. These are the 5 cases given under section 271 in which the petition for winding up can be filed. Okay, now you would have understood, by this time you would have understood that who all can go and file a petition before the tribunal. See, the company can go and file a petition, company, or we can say the shareholders if they pass a special resolution. The ROC can go and file a petition. The central government or the state government can go and file a petition, etc. These are the people who can go and file a petition before the tribunal that yes, we want to wind up this, or we wish that if you can wind up this particular company. Okay, now listen, if the company goes and files a petition suo moto, then company will have to submit its statement of affairs along with it. Statement of affairs was nothing but your rough balance sheet. Okay, company will have to submit its rough balance sheet along with that petition. But if suppose a petition is filed, suppose if the petition is filed by any other person, that is your ROC, central government, state government, then later on we will tell the company, that it is required to submit, its statement of affairs to the tribunal. So basically, whenever the company suo moto goes and files a petition, company will have to file the petition plus it will have to attach the statement of affairs. Right, if any other person goes and files a petition with the tribunal, then later on the company will be asked to submit the statement of affairs, so that we come to know about the financial position of the company. Right, now listen, once the petition is filed with the tribunal, what steps can be taken by the tribunal? Either the tribunal can accept it and say yes, we should wind up this company, or it can say no, it is utter nonsense, you should not wind up this particular company. Right, or it can appoint just to determine a few things. Primarily, it can appoint a provisional liquidator. Provisional liquidator is just like your IRP, interim person is there. Or when it is sure that yes, winding up should happen, then it can appoint a liquidator, the final liquidator also, which can be a company liquidator, that is from the database of the IBC, or it can be from the government servant, that is the official liquidator. We can appoint any particular liquidator, and whatever decision is taken by the tribunal has to take that decision within 90 days. Okay, once the petition was presented, once the winding up petition was presented, from that day, within a period of 90 days, the tribunal will have to take a final call that yes, what are we supposed to do? Should we accept it? Should we reject it? Should we dismiss it? What are we supposed to do? That has to be done. That has to be decided by the tribunal within a period of 90 days. Okay, and the last point which was there now under section 271, that is out of those 5 points, the last point, that is if the tribunal thinks that it is just and equitable that the company should be wound up, then say for example, if the company is merely insolvent, does not mean that the company should be wound up. We should give some opportunity to the company to revive itself. Okay, so basically the concept remains same as that of your IBC. The first resort should not be liquidation. The first resort should be revival. Okay, the first resort should be revival, and only after that, if it is not possible, then only liquidation, winding up, etc. should come into picture. Okay, now listen, say for example, if the petition was filed by the ROC, means, or if it was filed by the CG or SG, etc., that is any person other than a company. Okay, if suppose ROC filed a petition against me that my company should be wound up, then in that case, now the tribunal will tell me that against your company we have received a petition. So please file your objections, that what objections do you have against this particular petition, and please file the statement of affairs. Okay, now we are supposed to prepare this particular statement of affairs, and we'll have to submit it. Now we'll have to submit it before the tribunal. We have to submit our objections also, and plus we'll have to submit the statement of affairs also. So basically till now what has happened was, in which circumstances the winding up can happen? right? Then who all can go and file the petition? Then in which case statement of affairs is to be given when? When the company files a petition, company will give it immediately. If any other person files the petition, then we will have to submit the statement of affairs later on at a particular date. Right? Then comes your liquidator. Liquidator comes under your picture, just like I told you. If you want to appoint a temporary person, you can appoint a provisional liquidator. If you want to appoint a permanent person, then you can go with the company liquidator or the official liquidator. If I say company liquidator, then he is a professional independent person which we are going to take up from the insolvency and bankruptcy code. And suppose if it's an official liquidator, then we are going to take it from the government's database. Okay, so basically we appoint a liquidator. This person should be an independent person. He should have proper knowledge about this particular industry liquidation. Right, say for example, if you are doing the liquidation of a company who is into telecom sector, then that person should be having adequate knowledge about that particular sector. Right, then this liquidator can be removed also. Suppose normal answer, suppose if he is not independent, suppose he was indulged in any misconduct, if he was convicted of any fraud, if he is not capable of acting as a liquidator of this particular company, if there is any lack of independence, if there is any conflict of interest, then this particular liquidator can be removed. And if he is removed, then his work will be transferred to some other liquidator who is going to continue with the work. And if suppose our company has suffered any losses because of this particular liquidator, then this liquidator will have to reimburse those losses. Right? So all these things were happening here. Now listen, as soon as your liquidator is appointed, we'll first intimate the liquidator that boss, you have been chosen as the liquidator of this particular company. We are going to intimate it to the ROC that this particular company is going into liquidation. We are going to intimate the stock exchanges wherever the securities are listed. Okay, we are going to notify it in the official gazette. Suppose if the company is not a listed one, then we are going to notify this in the official gazette that this particular company is going to be wound up, so that basically everyone becomes aware. That this company is going to go into liquidation, and yes, this is going to be a discharge notice to all the employees, etc. Okay, this is going to be a discharge notice. Means what? Means that now you can go tata bye bye. Now you can go out from the company. See, if we want to continue the company as a going concern, then that's a different thing altogether. But if we are going to ultimately wind up the company, then this acts as a discharge notice to all the employees, workmen, etc. That boss, now your tenure in the company has got over. Now the company is going to close, and now you can go out from the company. Okay, then once a liquidator is appointed, after that we are going to appoint a committee, or we are going to form a committee. We are going to form a committee called as winding up committee. Okay, we are going to form a committee called as winding up committee, which contains 3 people. Okay, first one is the official liquidator, second one is the nominee of the secured creditor, and third one is the professional person. And these 3 people will be sitting in the winding up committee. The committee meetings, etc. will be convened by the company liquidator only. And the main purpose of forming this particular committee is to monitor the proceedings. Okay, this committee is going to monitor the proceedings. That is the liquidator working properly or not? Okay, are the assets getting recovered properly or not? Are the liabilities being paid properly or not? Is the valuation being done properly or not? Are the claims being settled in a proper manner or not? All these will be monitored. Okay, all these will be monitored by the winding up committee. Okay, so we can say at the lowest level we have the company liquidator. Above that we have the winding up committee, and above that we have the tribunal. Okay, at the lowest level we have the company liquidator, then we have the winding up committee, and then we have the tribunal. So if the company liquidator wants to communicate with the tribunal, okay, then it has to go through the winding up committee. Okay, so first the company liquidator will submit the draft to the winding up committee will approve it, and then only it gets submitted to the main committee. It will get submitted to the tribunal, right? Okay, now listen. Suppose if once the winding up starts, just like your moratorium. Okay, just like your moratorium. Okay, just like your moratorium, here also, if there are any legal cases, which are going on, by the company or which are going on against the company, then all will pause. Remember moratorium, all will pause here also. And but what they are telling is, if you want to continue with any particular case, then you can take an approval from the tribunal. Okay, you have to take the tribunal's permission, then only that case can continue. But for Supreme Court case or the High Court case, no approval of tribunal is required. That case can continue as it is. So basically they are trying to say, if any case is going on in any lower court, and if you want to continue that case even during the winding up is going on, that time you will have to take the approval from the tribunal. Right? Okay, then now here they are talking, now they are talking about some duties, powers, etc. of the liquidator. That what all things are supposed to be done by the liquidator. Okay, what all things are supposed to be done by the liquidator. Now once the liquidator comes into picture, he will now start checking everything. Okay, he will now start checking everything that he will start doing the valuation of the assets. He will start checking the contracts entered into by the company. He will start checking the liabilities of the company, the contingent liabilities of the company. He will start valuing the assets like we already discussed. He will start checking the guarantees given by the company. He will start checking the list of the contributors, who are the shareholders from whom we can call the money in case of any shortfall. Who in which all companies has our company invested, that is our subsidiary companies, our joint ventures, etc., or who is our holding company, etc. It is going to find each and every fact. It is going to try to find each and every fact about the company, and a report upon all these things will be submitted to the tribunal, so that we are keeping the tribunal in the loop. That whatever work is done by the company liquidator, a report of that has to be submitted to the tribunal mandatorily. Okay, a report on that has to be submitted by the company liquidator to the tribunal mandatorily. Also, the company liquidator will write in that particular report whether it has found any fraud or not. Okay, whether it is viable for the company to continue in the future or not. If it is viable, then yes, we can plan for revival. Right? All these, its opinion, the company liquidator's opinion can be written in that particular report. Right? And now, once the tribunal receives this report, from the company liquidator, then it will decide that whether it's a small company, whether it's a medium-sized company, whether it's a large company, how much time will it take for winding up the process, etc. So now the tribunal is going to fix a time period. It is not fixed for every company. Yeah? It is not same for every company, so it is totally subjective. The tribunal is going to fix a time period that within so and so time, the winding up should get over, and the time period can be extended also. No issues in that. In India, this is a very common thing, so it can be extended also. Suppose if investigation is required, then tribunal can order for investigation if it thinks that there is any fraud, etc. involved, and all those things will follow after that. Okay, now we're talking about the physical custody of the company's assets. Okay, talking about the physical custody of the company's assets, whatever assets were kept in the company. Okay, whatever assets were kept in the company, all those assets will now vest with the company liquidator. Means basically the custody comes with the company liquidator. Okay, if the company's assets were kept with the director of the company, if the company's assets were kept with some shareholder of the company, everything will now come in the hands of the liquidator, just like your insolvency. Okay, just like your IBC. Everything, all the control now comes. Okay, all these administrative controls now comes in the hands of the company liquidator. And suppose if the company liquidator needs more information, if it needs more information about the things which are written in the books of accounts, then it can seek the information. It can call for the information from the promoters of the company, from the directors of the company, from the officers of the company, and it is their responsibility to cooperate with the liquidator and to provide with the necessary information. Okay, to cooperate with them and to provide with the necessary information. If not done, then penalty will be applicable. No issues in that. Okay, now the next section number 285, this is an important section which says that how do we settle with the contributories, or how do we call the money from the contributories, from whom are we supposed to call the money, etc. This is the same thing which we had studied in our IPCC. Now just try to understand. I'm just revising this entire section for you. Say for example, if it's a company which is limited by shares. Okay, if there is a particular company which is limited by shares and now that company goes into liquidation, then the shareholders' liability will be limited up to the unpaid amount. The shareholders' liability will be limited up to the unpaid amount. So whatever is their unpaid amount on the shares, that much amount they'll have to bring now at the time of liquidation. Okay, this we are talking about the present contributories. Now let's go to the past contributories. First, we are going to try to recover the money from the present ones only. If that money is insufficient, then only we go to the past contributories. If we go to the past contributories, we go to only those shareholders who have left our company during the last 1 year. We cannot go to the old ones. Okay, only the ones who had left our company during the last 1 year, we can go to them. And if there was any unpaid amount on those shares, then we can call the money from them. Okay, this happens in case of this happens in case of a company limited by shares. Okay, and yes, one more important thing to be checked here is, suppose if the past contributory left our company, say for example 6 months back. Okay, but the liability for which we are raising the money, that arised now. that just arise, then we cannot call the money from that past contributory because he was not at all liable for that particular liability which is arise now. Okay, so two conditions should be there. First of all, at the time when he left the company, at that time the liability should be due and he should have some unpaid amount. Only then we can call the money from the past contributor. Okay, so basically if a company is limited by shares, then the liability of the shareholders is restricted up to the unpaid amount or the proportionate liability that is due from him, whichever is lower. When it's an unlimited company, which generally nowadays no one forms, but then too, if it is an unlimited company, then we can call whatever money from the present shareholders, whatever we want to call, we can call from them. Okay, then if it's a company which is limited by guarantee, okay, if it's a company which is limited by guarantee, then whatever amount was guaranteed by that particular person, okay, whatever amount was guaranteed by that particular shareholder, we can call that much amount, plus if there is any unpaid amount on the shares, we can call that much amount also. Okay, in case of guarantee, what happens is whenever they had subscribed to the shares, okay, whenever they had subscribed to the shares, they would have guaranteed that at the time of liquidation, I will pay 25,000, for example. So now it's time for them to give that 25,000 rupees. Okay, now say for example, suppose if later on during this particular process of liquidation, they say that by default rule is the directors of the company, the officers of the company, the managers of the company, they are liable in an unlimited manner. Okay, directors, managers, etc., they are liable in an unlimited manner because there is an inherent assumption that if the winding up is happening in the company, that is because of this mismanagement which is done by the directors. So their liability is unlimited. See, if they are having any shares in the company, then that liability is separate. But just because they were the directors, managers in the company, so their liability becomes unlimited. But if they prove that no, I was not liable, if they had left a company before the last 1 year, then they are not liable. If the liability arised after they ceased to hold the office, then they are not liable. So these are basically the exceptions. Apart from that, if you are simply the director or manager of a particular company, then you are by default liable in an unlimited. Okay, then comes another committee called as advisory committee. As you can identify from the name itself, advisory committee is the committee which basically it holds the meeting of the creditors, it holds the meeting of the contributories, and then it listens to their wishes. Okay, it listens to their wishes and then it advises the company liquidator, it advises the NCLT that what is to be done. An advisory committee constitutes of 12 members which are selected out of the members and the creditors only. So basically we are selecting the representatives from the creditors and the contributories. We conduct their meeting. The meeting is chaired by the company liquidator, etc. And then we decide that what is their wishes, what are we supposed to do, are we getting any new idea from them or not, and then after considering their views, only the company liquidator takes any further decision. Okay, suppose if there is any conflict between the advisory committee and the other creditors and the members, then in that case we are going to listen to the creditors and the members, because in the advisory committee we just have a small portion of that, we just have 12 members. But if the other members say that no, the decision of the advisory committee is wrong, then it is wrong. Advisory committee is just a representative. Okay, it's just a small portion of the members or the creditors, and the advisory committee has got all the rights to inspect the books, papers of the liquidator, to check the custody of the assets, etc. They have got all the rights. Okay, and whatever work is done by the tribunal, tribunal has to keep on reporting. Okay, tribunal has to keep on reporting to the company liquidator has to keep on reporting to the tribunal from time to time. Okay, generally it is on quarterly basis, but time to time the company liquidator has to report it to the tribunal that what kind of work is going on, what things have been completed, what things are still left, etc. Those things have to be reported on quarterly basis by the company liquidator to the tribunal. Right? Now listen. Can I say company liquidator works on the directions of the tribunal? Company liquidator works on the directions given by the tribunal. So what all powers can be exercised by the company liquidator after taking the approval from the tribunal? It can sell off the movable asset, it can sell off the immovable property, it can raise some short-term funds if required, it can handle any legal cases just like we had studied before, it can handle the High Court, Supreme Court cases, it can invite people for their claims, whose all money is pending, come and tell me. Just like in IBC, like we used to do public announcement. Okay, it can settle the claims. Okay, if it thinks that it is possible to run the company for a particular period, it can run the affairs of the company. Right? If it thinks that we require a professional advice from the valuer, we require some professional advice from a chartered accountant, we require a professional advice from a company secretary, it can seek those advices, etc. These are the powers. These are whose powers? These are the powers of the company liquidator, which it can exercise, but only after taking the approval from the tribunal. Okay, these are very, very general answers. And see, now here they have elaborated on their professional advice that CL can appoint, the company liquidator can appoint professional, it can appoint a chartered accountant, it can appoint a CS, it can appoint a legal practitioner, etc. to assist him. Okay, in the above, we were just taking their advice. Here, we are appointing that particular person in the company. Just like we can say that he is going to act for a larger period. Okay, in the above point, the thing that we studied, that is to obtain professional advice. That is, we will submit a particular matter, we will take the advice. And here we are appointing them. Here we are appointing them for a longer period where we are going to seek their advices on various matters. Okay, but again we have to just check. Again, we just have to check that there is no conflict of interest. Okay, there is no conflict of interest, there is no problem of independence, etc. And just like I had told you, in advisory committee, we have the creditors and contributories only. Right, so whenever required, see, ideally advisory committee consists of the creditors and the members only. So we listen to them, we take their consider their views, etc. Okay, alternatively, if we want more people to give their views, we can even call the meeting of the creditors and the contributories, etc. See, in advisory committee, the numbers are restricted. It is restricted to 12. But when we go to the creditors and contributories, the numbers increases. So we can call their meeting also to ascertain their views, or to listen to their views, or to listen to their ideas. We can call their meeting also. Right? Then the next thing, section number 293, which talks about the books of accounts of the company liquidator. Okay, now the company liquidator, if he is selling any particular asset, he will record it in the books. If he is paying to any creditors, he will record it in his books, etc. So these books have to be properly maintained by the company liquidator. Okay, and these books can be inspected. These books can be inspected by the members, by the creditors, by the advisory committee, etc. subject to the rules. Okay, generally what happens, we are going to study it further. Generally what happens, when the creditors, members, etc., when they come and inspect, then there are certain rules applicable. But when there is CG or SG inspecting the books of accounts, then no rules will be applicable for. Okay, and once they inspect the books of accounts, suppose once the company liquidator maintains the books of accounts, they are also required to get it audited. Okay, CL also has to get his books of accounts audited, and the report will be submitted. One copy will be submitted to the tribunal, another copy will be submitted to the ROC. This audit report copy will be submitted. Okay, this will be submitted to the tribunal, and another copy will be submitted to the ROC. Right? Now listen. One important point here, which I had already marked in our batch, was if suppose the company which is into liquidation is a government company. Okay, if the company into liquidation is a government company, then along with your tribunal, along with your ROC, you are also required to submit the report of this particular audit. This audit report is also supposed to be submitted to the member of that government company. If CG is a member, report has to be submitted to the CG. If SG is a member, report has to be submitted to the SG. If both of them are the members, then the report has to be submitted to both of them. Right? Then the next thing that they are telling is, suppose if this is a very simple section which they say that suppose if you are a company and you have a contributory. Okay, you have a shareholder from whom you are supposed to take the money. Okay, from the contributory you have to receive the money. But suppose if you already have his advance money kept with you, then you can set it off. Okay, then you can set it off. Okay, suppose if your company is into surplus. Even during liquidation, suppose if your company is into surplus and if you want to distribute the surplus to the contributory, if you want to pay any amount to the contributory, and if any amount was due from the contributory, then even that can be adjusted. Okay, similarly, it can happen in case of a director who is also a shareholder. If there is any amount which is due, then that can be set off against the amount which is payable. But the one thing which cannot be set off is the dividend. Okay, one thing which cannot be set off is the dividend. Say for example, if you have to take some amount from the contributory, say for example, if you want to take 10,000 rupees from the contributory, and now the contributory says, no, I have not received the dividend for the last 5 years, so I am not going to pay this 10,000. So is it allowed or is it not allowed? Obviously it won't be allowed, because provided it is an undeclared dividend. Provided it is an undeclared dividend. Suppose if it's a declared dividend, then yes, it is a liability of the company. But if it is an undeclared dividend, then the contributory cannot say that my amount will be set it off against this particular dividend, because announcing of dividend or payment of dividend is not mandatory, right? And the next one that they are telling us here is, whenever the company faces any deficit at the time of liquidation, maybe because the liability is more, okay, maybe because of the liability is more, then the company can call for the money. Or whenever there is any calls in arrears, at that time also the company can call the money from the contributory. It has got the rights. Okay, the company law says that there is no specific provision required for that, but the company has got the rights that it can call the money from the contributory. Okay, and if at all there is any surplus, suppose if at the end, if there is any surplus after making payment to all, then whatever is the surplus left is distributed amongst all the equity shareholders in the ratio of their paid up share capital. Okay, the surplus gets distributed among the equity shareholders, this we already know, but this gets distributed amongst all of them in the ratio of the paid up share capital, right? Then after that, say for example, if the company liquidator is of the opinion, suppose if the company liquidator is of the opinion that the books of accounts of the company is kept with a particular person, or if the property of the company is kept with any particular person, then we can call that particular person before the tribunal. Okay, we can call that particular person before the tribunal. The tribunal has the right to question that particular person about, do you have the books of the company, do you have the assets of the company or not, and accordingly the steps will be taken by the tribunal. Suppose if the tribunal comes to know that yes, this person is in possession of the books of accounts of the company, then the tribunal will recover, the tribunal will try to seize the books of accounts of the company. If the tribunal thinks that this particular person is having the assets of the company, which actually belongs to the company, then it will try to recover those assets from that particular person, right? Similarly, if the tribunal is of the opinion, or if the company liquidator is of the opinion that the promoters, directors, etc., they are involved in some fraud, okay, or some assets are there with them, or some books of accounts and papers, etc., are there with them, then also the tribunal can call them for inspection, etc., and it will make sure to give a final decision that whether they are having the books of accounts in their custody, whether they are having the assets in their custody or not. Okay, and if suppose any of these people are trying to run away, or if any of these people are trying to leave India, if any of these people are trying to leave secretly, absconding, okay, then in that case, if we come to know about them, okay, if suppose a particular person is trying to avoid the call money payment, if a particular director is trying to run away from his unlimited liability, and if we come to know, then we can seize that, we can arrest that particular person. Okay, we can stop that particular person from leaving India. Okay, I don't know how much practically it is happening, but anyway, we can stop that particular person from leaving India. Similarly, if that person is leaving with some assets, we can seize the assets of that particular person. If that person is leaving with the books of accounts of the company, we can seize those books of accounts of the company. So basically, tribunal has given the company law has given the powers to the tribunal that all these things can be done. Okay, and once the winding up is over, after that, ultimately the company is dissolved. The dissolution order is passed by the tribunal, just like every other law. The dissolution order is passed by the tribunal. Once the dissolution order is done, after that, the company liquidator is supposed to submit it to the ROC. Basically, we are intimating it to the ROC that boss, liquidation of this particular company has been complete. Right? Then, going on to the next one, what is the priority of payment? Okay, going on to the next one, that is, what is the priority of payment? How are we supposed to make the payment? What is the sequence of payment in case of winding up? So, first of all, we are supposed to pay. To the overriding, or we are supposed to do the payment for the overriding preferential payments. Okay, overriding preferential payments. In that, I am combining the provisions as well as the proviso. In that, first we are supposed to pay the dues to we are supposed to pay the wages and salaries to the workmen and the compensation to them under the Industrial Disputes Act for the last 2 years. For the last 2 years we are supposed to pay, and we are supposed to pay the accrued holiday remuneration to the workmen. Okay, this is the first thing. This is the first thing that we are going to pay in full to the employees or to the workmen under this Industrial Disputes Act, etc. right? After that, we are supposed to make the payment in pari passu to the workmen, to the other workmen who could not be paid in the first point. We are supposed to make the payment to the workmen, and we are supposed to give the money to the secured creditor. Okay, just remember one thing, all this money, whatever we are studying in section number 326, all this is paid out of the secured asset only. All this is paid out of the secured asset which was given to a secured creditor. So this money not only belongs to the secured creditor, this has to be shared by the workmen also. Okay, just like IBC, here also they have given priority. Here also they have given the priority to the workmen. Okay, so first we are going to pay to them under section 326. Then we are going to go and make the payment of all the winding up expenses. Okay, all the expenses and cost of the winding up will be paid then. Okay, after that comes section number 327, where we are going to do some preferential payment. That is, we are going to pay the government taxes for the last 12 months. We are going to pay the wages or the salaries for the last 12 months, and out of that also we are going to pay only for the 4 months in preference, in priority. Okay, then we are going to pay the accrued holiday remuneration to the employees. Earlier we paid to the workmen, now we are going to pay to the employees. Okay, similarly, if any employer's contribution was due to any fund like Provident Fund, ESIC, etc., if any contribution was paid, if any contribution was due, then we are going to pay that. If any compensation was payable under the Compensation Act, Workmen Compensation Act, then that has to be paid here. If any money was due from the Provident Fund to the employee, then we are going to pay that to the employee first. And any other investigation expenses which were due from the company, we are going to pay these 7 points proportionately. Okay, as it is written here, all these will be ranked equally. All these will be ranked equally means all these will be paid in proportionate, all these will be paid in pari passu. Right? And all these are paid in the priority. Okay, all these are paid in priority to all the unsecured debts. So first we paid 326. Then we paid the winding up expenses. Then we made the preferential payments under 327. Then we are going to pay to the creditors who are secured by the floating charge. Then we will go to the other unsecured creditors, then preference shareholders, and then equity shareholders. Okay, this is the sequence. This particular thing is the sequence that we have to apply whenever we are doing winding up as per the Companies Act. Please do not mix this up with the IBC schedule. IBC is to be followed when we are doing liquidation under IBC. This is to be followed when we are doing liquidation under the companies, right? Then going on to the next section. Next section is a little important. Section number 328, which we have studied in IBC again. Fraudulent preference. That is, if the company, in this subsection 1 says that if suppose the company has given preference. Okay, if suppose the company has given preference to any creditors of the company, and it has put that particular creditor in a better position in the preceding 6 months before the winding up had commenced, and if later on we come to know that no, this is not in a ordinary course of business, then the position will be totally restored. Okay, the position will be totally restored. The tribunal will say that please reverse back the transaction if you have given any wrong preference to any creditors during the last 6 months. And similarly, if you have fraudulently transferred the property of the company to any person, which is actually not done for a proper consideration, or which is not done in ordinary course of business, and if it was done during the last 6 months, then again the transaction will be treated as invalid. The tribunal will simply declare the transaction as invalid, and once the tribunal declares the transaction as invalid, then even the company liquidator treats that transaction as void. Okay. Now the powers with the tribunal is there for all the transactions which were done during the last 6 months. But the company liquidator can treat that particular all those transactions which were done during the last 12 months as void ab initio if they were not done in ordinary course of business, and if they were not done for a valuable consideration, then the company, the transaction becomes void against the company liquidator. That is, the company liquidator will treat the transaction as void ab initio, as if the transaction has never ever happened. Okay, now suppose if the company wants to transfer any assets. Okay, if the company wanted to, see, now we have already studied that company cannot give any preference to its creditors. Okay, now is suppose if it is done in ordinary course of business, then there is no problem. But if it is not done in ordinary course of business, and if it wants to give the preference to the creditors, then that was totally prohibited as per section 328. So the company devises another method. The company transfers the assets to the trust, or the company transfers the money to the trust, and then the trust gives it to the creditors. So they say that this is also not allowed. First of all, fraudulent preference is not allowed, and you cannot even involve any trust in between, and you cannot pay to them also. Okay, and listen, one more thing. Suppose if the transaction gets reversed. Okay, suppose you were trying to give any fraudulent preference to the creditors, and if the tribunal says that no, this transaction is invalid, then the transaction will be reversed. Okay, but then too, the amount which was due to the creditor, he will still receive it. Okay, whatever amount was due to the creditor, he is still going to receive it. Right? His interest won't get affected. The only person actually is getting punished is the company who was trying to give the fraudulent preference. Now, similarly for the floating charge, if suppose the company had created any floating charge, okay, if suppose the company had created any floating charge on the assets of the company during the last 12 months before the winding up, then they are telling that that floating charge will be treated as invalid. Okay, that floating charge will be treated as invalid, but the money of those creditors, I had given the example of the debenture holders, the money of those debenture holders will be secured to the extent of the principal amount plus interest at the rate 5% on it, 5% per annum interest on it. But if the company proves that at the time when the charge was created, at that time the company was solvent, then the charge will be treated as a valid charge. Okay, means basically they are trying to say if the charge was created in good faith, then no problem. But if the charge was created when the company was insolvent, then in that case that charge will be treated as invalid, and now but the money of the creditor will be secured, the principal amount plus the 5% interest per annum will be secured. This amount he is 100% going to get. Then the next concept that we did was onerous property. Suppose if the company liquidator comes to know, that a particular property which is there in the liquidation estate, that is a burdensome property. Okay, this property is going to give us a heart attack. This is a burdensome property. Because of this property, our liquidation estate is not going to increase, but it has reduced. Then in that case, the tribunal can decide to disclaim that property. Okay, it can say that I withdraw all my rights. From this particular property. So now you're the liquidator can make an application to the tribunal within 12 months from the date of commencement of winding up, or 12 months from the date when the liquidator becomes aware about this onerous property, whichever is later. Within this time it can make an application to the NCLT, and it can make an application for disclaiming of the property. If the tribunal is satisfied, it will allow the liquidator to disclaim that particular property. Okay, it will generally happen when the property is burdened with debt, if the property's title is not clear, if the expenses are more than the benefit that we are going to get from this particular property, if the contracts in which we have entered, if the investments which we have done in the joint ventures, etc., if those are loss making, then in that case we can disclaim those properties. Right? Similarly, if this property was a mortgaged property, then suppose if it was mortgaged with a bank, then bank becomes the interested party. Interested party will get a heart attack if this property is now treated as an onerous property. So it will go and make an application to the CL asking that, boss, are you going to disclaim this property or not? And the liquidator is supposed to reply within a period of 28 days plus the extended period that what call it has taken, whether it wants to disclaim the property or whether it is going to keep the property. And accordingly, later on the decision will be taken to disclaim, either to disclaim or to keep the property with the liquidator. Similarly here, suppose if you want to exit from any contract, okay, contract is also your asset, contract is also your property. Suppose if you want to exit from any contract, and if that contract asks you to pay any penalty, if that contract asks you to pay any compensation, then you'll have to pay that from the liquidation estate, and then only you can exit from there. Okay, then only you can exit from. Am I very clear with this? This was all about the most important points. This was all about the most important points about your onerous contracts or disclaimer of the onerous property. Okay. Now just try to understand. Once the winding up has started, company loses all the rights. Okay, once the winding up has started, company loses all the rights for doing any major change, in the company. Example, change in its share capital. Okay, selling of any assets, change in its assets, etc. No, the company cannot do now, because now there is a shift of control. So if the company does any such thing without tribunal's permission, then that will be treated as void. Okay, if the company does any such thing without the approval of the tribunal, then that thing will be void. Okay, that cannot be done. Now, once the winding up has started, your assets cannot be attached by any other person. Okay, your assets cannot be mortgaged by any other person except for the government taxes. For government taxes, they can attach your property, no issues in that. But any, say for example, you want to raise some short-term funds. For that, banks ask for any property, etc. No, you cannot give any mortgage. But if the government wants to, okay, if the government wants to attach your property for recovery of the tax due, yes, it can be done. Yes, it can be done. Okay, then next section is talking about the penalties, etc. Suppose if any particular person in the company does any default with the liquidator. Ma'am, what kind of default? He does not give all the information to the liquidator. He does not disclose everything to the liquidator. He does not give the books of accounts, books and papers to the liquidator. He does not give the assets to the liquidator, etc. He omits some very important thing about the company. He gives any false information about the company, and that particular person would be liable with a non-compoundable offense. Okay, that particular person will be liable with a non-compoundable offense. And then once the company is into liquidation, okay, once the company is into liquidation, whatever office stationery is there of the company, okay, whatever office stationery is there of the company, its bills, documents, letterheads, etc., everywhere it should be written, that yes, the company is into liquidation, so that everyone comes to know about it, that yes, the company is going to go into liquidation, or the company is into liquidation. Okay, and whenever you want to find out any fact about the company, okay, whenever you want to find out any fact about the company, the first thing that you need to check is the books of accounts of the company. Okay, that is a prima facie evidence for each and every matter. See, if you want to go into detail, then you can, gather the things from different sources. But the prima facie, the primary place is nothing but the books of accounts of the company. Okay, and these books and papers, this I had already mentioned earlier, books and papers of the company can be inspected by creditors contributory subject to the rules and regulations, and it can be inspected by the government with no rules and regulations. Means if the government wants to inspect it, then no rules and regulations will be applicable. Okay, once the company is wounded up, once the dissolution, etc. is done, now the company can dispose of its books of accounts and papers. You had told me that it can dispose of the books of accounts, papers, etc. First, it will preserve for some number of years, that is 5 years. Okay, the company liquidator has to preserve the books and papers of the company for a period of 5 years. After a period of 5 years, after a period of 5 years, no one would be liable for those books and papers. Means after a period of 5 years, even if you don't preserve it properly, or even if you destroy it, that's absolutely alright. Okay, now listen, the next important thing here is on which a question can be tested, that is, suppose if once a liquidator decides that, okay, so and so amount is payable to the creditor, so and so amount is payable to the contributory, etc. Now, at the time of payment, if the company liquidator thinks that, oh, this creditor is untraceable, this contributory is untraceable, this is possible, okay, this is 100% possible, then the company liquidator will keep on trying for a period of 6 months. It will try to find out that creditor, it will try to find out that contributory for a period of 6 months. If within a period of 6 months also it is not able to pay to the creditor and the contributory, it will deposit their due amount in a special account called as company liquidation dividend and undistributed assets account. It is going to transfer in that particular account. Okay, the money will be kept in this particular account for a period. The money will be kept in this particular account for a period of 15 years. Okay, and if later on that creditor or the contributory comes in the picture and he says that I want my money, then he can go and claim it from the ROC. Okay, because this account, this company liquidation dividend blah 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 account is under the control of the ROC. So that person, that creditor or the contributory can go and make an application to the ROC, and then the ROC can pay the money out of that particular account. Okay, if the money is kept in that particular account for a period of 15 years, then after that it gets transferred to the general reserve account of the central government. From that also the money can be taken, no problem in that, but the account changes. Okay, and the primary responsibility is with the liquidator. Liquidator cannot keep the money with him. He can keep it for a period of 6 months, no doubt in that. But later on he has to deposit in that special account, and then from the special account it goes to the general reserve account. If he retains the money with himself, he can be liable for expenses, he can be liable for termination, he can be removed, his remuneration can be seized, plus he can be also liable for interest at the rate of 12% on the money that he had wrongfully retained with himself. Okay, and all these, just to keep a control on all these things, liquidator is supposed to submit returns. Okay, liquidator is supposed to submit returns to the tribunal from time to time. Okay, if the liquidator does not submit it with before the due date, then it will get a a warning. It will get a warning from the tribunal to submit it within a period of 14 days. If it still does not submit the returns etc. within the 14 days from the due date, then it will be liable for the penalties. No issues in that, right? Then again, a general section said that if suppose whenever we are calling the meeting of the creditors, whenever we are calling the meeting of the contributories etc., and whenever we take their vote, then how are we supposed to ascertain their vote? So the answer is, in case of creditors, we are going to take the value. We will take their value of the debt. And in case of contributories, we are going to take their voting power. So as to give a proper, fair treatment to the voting which is done by the creditors and the contributors. Okay, again a general section which says that whenever you are preparing any affidavit, okay, before whom are you supposed to go and swear? Okay, before whom are you supposed to go and swear? So it can be before the court, it can be before any government servant, it can be before any authorized person just like notary or before any gazetted officer. When it's outside India, it can be before before an Indian diplomat, or it can be before any consulate officer. Before these people you can go and sign, these people can attest it, which means that yes, the affidavit is certified. Okay. Similarly, now last point here, suppose if the winding up is done, the dissolution order was passed by the tribunal, but later on if any person thinks that no, this dissolution was not correct, it should not have happened, then in that case that person can go and make an application to the tribunal within a period of 2 years from the date of dissolution. And if the tribunal thinks that yes, the dissolution order was not proper, then the tribunal can restore the position. Means it can say that the dissolution is void and now the company becomes an active company. And this order we are supposed to go and file as usual. This order we are supposed to go and file with the ROC, so that even the ROC comes to know that yes, now this company has been deemed as an active company. Okay, and in the entire chapter, wherever they are using the word, the winding up has commenced. Winding up has commenced is nothing but the date when we had filed the petition under section 271. The circumstances in which the petition were filed, or the people who had filed the petition under section 272, whenever that was done, that was the date when it will be deemed as if the winding up had commenced. Okay, so this was an overview. This was an overview of all the important sections of this particular chapter. Even if you do this much, and plus if you practice the back questions, at least the subjective ones, okay, even if you do this much, plus if you practice the back questions from the chapter, it would be sufficient. Okay, it would be sufficient, it would be more than enough. So with this, we are done with the revision of winding up chapter. Let's start with the super quick revision of appointment and remuneration of managerial personnel, which is ranging between section number 196 to section number 205. Section number 196 to section number 205. First of all, three terms are very important. The first one is your managing director. The first term important here is your managing director. Managing director is basically, first of all, he should be a director. That is, he should be appointed to the board of directors of the company, and he should be entrusted with the substantial powers of management. If he is entrusted with the substantial powers of management, then such director can be called as a managing director. Okay. The power of doing routine work or the power of doing administrative activities which can be done by every other director, those powers are not given. To a managing director because specifically they have specified in this definition section that he should be entrusted with substantial powers of management. Okay. Now this particular managing director, a particular person can be a managing director in maximum 2 companies. This we are going to study in the KMP section. Okay, a particular person is there, he can be a managing director in maximum 2 companies. And a particular company can have any number of managing directors. It can have 1, it can have 2, it can have more than 2 also. It can have any number of managing directors in its company. Okay, these were the most important pointers for the managing director. Second thing that comes up there is the definition of the term manager. Okay, manager is also having similar powers. Manager is also having similar substantive powers of management, which was there with the managing director. The only thing here is, if in a company, if we are appointing any particular person in the place of a manager, then there can be a single manager only. Okay, there can be only one manager. Unlike MD, in MD we were allowed to appoint any number of managing directors. But if you want in your company that even one person who is having the substantial powers of the management is sufficient, then you may appoint any person as a manager, and this manager can be a director, or this manager can also not be a director. Okay, unlike MD, full form of MD was your managing director, means that person was compulsorily supposed to be a director. But in case of manager, it's not necessary for that particular person to be a director. Okay, so he can be a director, he cannot be a director, but again he is having the substantial powers of manager. Going on to the third definition, the last definition, that is your whole-time director. Whole-time director is such a person. Whole-time director is such a person. First of all, he is such a director who is in whole-time employment of the company, and he is managing all the day-to-day affairs of the company. Okay, he is entrusted with all the administrative powers which are not there with the managing director. Okay, the powers which were not there with the managing director, those powers come to the whole-time director, that is all the administrative powers. Okay, if there is a particular, first of all, in a particular company, we can have any number of whole-time directors. Okay, in a company, we can have any number of whole-time directors. It can be 1, it can be 2, or it can be any number. And then a particular person can be a whole-time director he can be whole-time in one company. Okay, he can be a whole-time person in one company. However, he can be a director. He can be an ordinary director in another company. Okay, we are going to study 1 or 2 points of exception in the KMP section, that is section number 203, which is going to come later on. But this is mainly what we are supposed to know about the whole-time director. Okay, so he is a normal director. He is into whole-time employment of the company, and the company can have any number of whole-time directors. Now going on to the next section, the important section, section number 196, which talks about appointment of the managerial personnel. Okay, all these three people, managing director, manager, whole-time director, all these people are cumulatively these people are called as managerial personnel. Okay, so we are studying the appointment of managerial personnel. The first thing which comes up in this particular section is a company at a particular point of time, or at the same time, a company can either have MDs or a company can have a single manager. Remember, manager we can have only one. So at any point of time, we can either have MD or we can have manager. We cannot have MD as well as manager in the company. No, that's not allowed. Okay, and whenever you are appointing any managerial personnel, they can be appointed for a single term. They can be appointed for a single term up to 5 years. They can be appointed for a single term up to 5 years. They can be reappointed also. Immediately after that. There is no issue in that. But the reappointment cannot happen too much in advance. The reappointment can happen in the last year of expiry. Okay, that is just 1 year before the expiry. During that last term, only during that time the reappointment can happen. Okay, if you want to do it in advance, or else alternatively you can do the reappointment once the tenure is over. Now, section number 196, subsection 3, which is very, very important, which talks about the disqualification. We are going to get 4 points here. If any of the pointers are attracted, then that particular managerial personnel is disqualified for appointment. Okay, first of all, if he is below the age of 21 years, or if he has attained the age of 70 years, if he has touched the age of 70 years, or if he is below the age of 21 years, then he is not eligible for appointment. Okay, but here we have certain exceptions. We have 2 exceptions here. First exception is if suppose the company passes SR. Okay, this exception is first of all for the people who have touched the age of 70 years. If you still want to appoint that particular person, then your company can pass a special resolution and that particular person can be appointed. And for this special resolution, when you are giving the notice to the shareholders for this meeting, then you have to attach an explanatory statement that why you still want to appoint this 70-year-old person in your company in the position of managerial personnel. If you are not able to pass SR, but you have passed a resolution where the votes casted in favor is more than the votes casted against it. Okay, where the votes casted in favor is more than the votes casted against it, and plus you have taken the CG approval. Okay, in this case you have to take CG's approval. If you have taken that, then in that case appointment will be valid of this person who has already attained the age of 70 years. Okay, second point of disqualification is if that particular person is an insolvent or is adjudged to be an insolvent. If this particular person has not made the payment to his creditors, he has suspended the payment to his creditors, he has compounded with his creditors, etc. And the last point, if he has been convicted by any court, be it Indian court or be it foreign court, and he has been sentenced to imprisonment for more than 6 months, If any one of the pointers are attracted here, then in that case, that particular person is disqualified for appointment and then he cannot be appointed as a managerial person. Okay, whenever any person, suppose if these disqualifications are not attracted, means he is qualified for being appointed. So in that case, first you'll have to take the board's approval, then you'll have to get it ratified, from the shareholders in the immediate next general meeting, and in some cases we require to take the approval of the central government. Okay, we are going to study those cases also. One case we have already studied, that age of 70 years, and more 3 cases we are going to study where we are supposed to take the approval of the central government. Okay, only then that particular person can be appointed. Once that person is appointed by the board, within 60 days we have to go and file a return in form number MR1 with the ROC about the appointment of such managerial person. Okay, then if suppose CG approval is required, then we have to file form number MR2 with the central government within 90 days from the date of appointment. Okay, if you want to take the CG's approval, then that has to be done within a period of 90 days. Suppose if the board has done the approval of a managerial personnel, and later when we took the ratification in the by the shareholders in the general meeting, suppose if the shareholders did not ratify it, suppose if the shareholders did not approve it, then this managerial personnel was anyway acting in between, then the acts done by this particular managerial personnel in between will be deemed as valid. As if he has worked in good faith, the acts done by him in between will be valid. Okay, now 4 cases where we are supposed to take the CG approval. Okay, 4 cases where we are supposed to take the CG approval by making an application in form number MR2 within a period of 90 days from the date of board's approval. Right, first case is suppose if he is imprisoned for any period, or he is liable for any fine of more than ₹1,000 under any specific act, then in that case we have to go and take the approval from the CG. If CG approves, then this particular person can be appointed. Or if he has been detained under Conservation of Forex and Prevention of Smuggling Activities Act, if he is detained for any period, then in that case we have to take CG's approval if we want to appoint this particular person. Okay, if he has attained the age of 70 years and if SR is not passed, then in that case you have to go and take the CG's approval. Remember, votes casted in favor should be more than votes casted against it, and we have to take the CG's approval. And the last point, if that person is not a resident of India. Okay, if that person is not a resident of India, means for the last 12 months he was not staying in India continuously, then in that case you have to take the CG's approval. If CG says okay, then it will be okay. Okay, and this residence point is not applicable for the companies which are located in SEZ, because in that we can have managerial personnel who are not residents in India. Right, so this was all about your section number 196. Okay, this was all about your section number 196. Now going on to the most important section of the chapter, that is section number 197. Okay, section number 197 talks about what? Section number 197 talks about remuneration. Okay, 197 talks about the remuneration. We are going to study different things here. The first thing that we have to take up here is the case where the company is having sufficient profits, the case where the company is having adequate profits. Okay, now suppose if it is a public company, first of all, this point is applicable only for a public company. If we have a public company and if it is having sufficient profits, then it can pay remuneration to its managerial personnel and to other directors. Up to 11% of the net profits, and net profits will be determined as per section number 198. Right, net profits will be determined as per the next section, that is section number 198. Okay, now in this 11% also has a particular bifurcation. Now in that, the second proviso says that, first of all, they have given a limit, and if those limits are exceeded, then we'll have to pass a special resolution. Okay, we'll have to pass a special resolution. Now ma'am, what are the limits? Okay, generally, if you want to pay within the limits, then if there is a single managerial personnel in the company, okay, either there is one MD or there is one manager or there is one whole-time director, any one of them is present there, then you can pay 5% of the net profits to that particular person. Okay, you can pay 5%. If you have more than one managerial personnel in your company, then to all of them together, you can pay 10% of the net profits. Okay, this payment, 5% or 10%, this was done to the managerial personnel. Okay, this was done to the managerial personnel. Ma'am, what about the other directors? If we do not have any managerial personnel in the company, we just have other directors, then these other directors will get 3% of the net profits. Okay, if we have MP and we have other directors also, then these other directors will get only 1% of the net profits as their remuneration. Okay, if any one of these limits are exceeded, then we'll have to pass a special resolution, and you can pay more than these limits only if the company suppose if the company has defaulted in making the payment to 4 of them, either to the bank or to the PFI or to non-convertible debenture holders or to any other secured creditor. If the company has done any default with them, then we have to take their approval also. Okay, we'll have to take their approval also, and then only you can pass the special resolution and you can get the limit increased. Right? Now, this is the remuneration for the work that they are doing in the company. Right? Apart from this, they would be attending the board meetings of the company. So what extra are they going to get along with that? Along with this remuneration, they will get sitting fees also. Means this sitting fees is not included above. This sitting fees will be over and above the remuneration. Okay, suppose if the company does not have sufficient profits, then we are going to deal with it separately. Then this provision, this 1%, 3%, 5%, 10%, this won't be applicable. Then that will be dealt separately, as we must have already studied that in case of insufficient profits or no profits, we are going to pay on the basis of effective capital. Right? Now, whenever the remuneration, suppose if we are fixing the remuneration. Okay, how do we fix the remuneration? The remuneration clause will be there in the Articles of Association. If it's not there in the Articles of Association, then you can pass an ordinary resolution. If AOA wants you to pass a special resolution, then you'll have to pass a special resolution and then you'll have to determine the remuneration. Suppose if this particular managerial personnel or if this particular director is acting in some other capacity also. Okay, like in the regular lectures, I had given you the example of doctor. Director also acting as a doctor. Then can I say for treating the patients in a particular hospital company, he would be charging some fees, etc. So he can get these professional fees also over and above his remuneration, over and above his sitting fees. Right, but provided it should be proved that he is acting in a professional capacity and means the services that he is giving is of professional nature, and the NRC or the board should approve this particular payment. NRC means your nomination and remuneration committee, or if there is no NRC, then the board should approve this particular fact that yes, this director is providing the services in some other capacity, so he is eligible for this extra amount. Right? Then going on to the next one, coming on to sitting fees. Okay, how much sitting fees? We have already discussed that sitting fees can be extra paid, like over and above the remuneration, sitting fees can be paid. How much sitting fees can be paid? Sitting fees maximum up to rupees 1 lakh per meeting. Right, this is the sitting fees that can be paid to each director for the board meetings that they have attended. An independent director and women director should not be paid anything less as paid to the other directors, means even they should be paid at par with the other directors. Right? Now, this remuneration can be by way of a particular percentage that you pay every monthly, or it can be on some periodically basis, or it can be maybe if the director agrees, and it can be on yearly basis also. Right? The net profit that we are going to calculate, the net profit that we are going to use for the purpose of section number 197, that is going to be mentioned. How are we going to calculate that net profit? That calculation of net profit, that thing is given in section number 198, right? Which is the next section. The calculation of that particular net profit is given in section number 198. Suppose if say for example, while paying any remuneration, suppose if there was any calculation error, and if we have paid any extra remuneration to any particular person, then in that case we cannot, by default you cannot waive off that. By default you cannot waive off that. First option is you will recover. Okay, first option is that particular person who has received this extra remuneration, that person has to refund it back to the company within a period of 2 years. Okay, he has to refund it back to the company within a period of 2 years, and till that time he has to hold it on behalf of the company. Okay, he is holding for the till the time he refunds it back, he is holding it on behalf of the company. Okay, suppose if the company says, okay, no problem, keep this extra remuneration with you, then in that case, the company can pass the SR and the company can waive off this amount. Okay, but for this, if the company has defaulted with outsiders, those bank, PFI, non-convertible debenture holders or other secured creditors, if the company has done any default, then we'll have to take their approval before we waive off their amount and before we pass the special resolution. Okay, so two options are there. First option is recover that amount within a period of 2 years. If you don't want to recover it, then simply you can waive it off by passing a SR within a period of 2. Okay, suppose if the company does not have profit, then again I am repeating, we are going to pay as per on the basis of effective capital. Okay, section number 197 subsection 12. Section number 197 subsection 12. This just talks about your disclosure. Okay, listed company is required to do certain disclosure about the remuneration paid, about the median remuneration paid to the employees in the company, median remuneration paid to the directors in the company. What is the, how many number of directors do we have? How many number of employees do we have? How many number of permanent employees do we have in the company? What is the remuneration paid to each of them? What is the qualification which is there with each of them? How much increase as compared to past year's remuneration has been given to these particular employees, directors, etc. These disclosures have to be made by the listed companies specifically. And two more important things that they have to disclose here is, first of all, a list of the top 10 employees as per the amount that they are receiving, and then the name of those employees who are receiving more than or equal to 8,50,000 per month of remuneration if they were employed for part of the year, or if they were employed for the entire year, and if they were receiving more than or equal to 1 crore 2 lakh rupees. If they are receiving more than or equal to 1 crore 2 lakh rupees in a particular year, then even those names, the name of those employees, directors, etc. have to be disclosed there. And if there is any particular person who is holding at least 2% of the share capital of the company, but he is drawing something more than the managerial personnel, then we have to give his name disclosure also, that boss, who is this particular person who is drawing even more than the managerial person, right? Then, similarly, if we have taken any insurance, okay, similarly, if we have taken any insurance for the acts done by the managerial personnel, okay, that is, if any particular act is done by the managerial personnel and if the company suffers any losses for that also the company can get itself insured. Okay, for that the premium is paid by the company. Okay, that is the cost for the company. But as soon as the person is held guilty, from that particular time period, the premium will form part of remuneration. Means the premium will no more be the cost of the company, but it will be recovered. From the remuneration. Okay, this managerial personnel, if he is there as a director, etc., in some other company also, then he can receive it. Then he can receive remuneration from the other company also. There is no restriction in that. Okay, if the provisions of this particular section, entire section, is contravened, okay, if any of the provision of section number 197 is contravened, then in that case, punishment will be applicable on the company and on that particular person. Auditor of the company has to make the disclosures. Auditor of the company has to make the disclosures in his audit report that whatever remuneration was paid by the company was within the limits, and if it was not in the limits, then the company has fulfilled the requirements. That is, suppose if we have paid more than the limits, then we have passed SR, etc. All those compliances have been done. This has to be disclosed by the auditor in his audit report, which you must have already studied in section number 143, right? 197.17 was a transitional provision, so I am ignoring it for the time being. This exception for the Nidhi company, this was an exception for the Nidhi company. You can just read it once, which says that in case of Nidhi company, if there are no managerial personnel, then you can pay something more. That instead of 3% that we were paying to the other directors, if there is no managerial personnel, you can pay some other amount, that is 15 lakh rupees or 10% of the net profits, whichever is lower, and if you want to pay more than that, then SR can be passed, right? Now, going on to the next case where the company is not having adequate profits. Okay, either the company is having insufficient profits or the company is not at all having any profits. Then in that case, the company can pay remuneration only to its managerial personnel, based on the effective capital. Okay, there was some limit of this effective capital. That is, if the effective capital is negative, or if it is less than rupees 5 crore, then you can pay up to 60 lakhs for the entire year. If it is 5 crore and above, but it is less than 100 crore, then you can pay 84 lakhs. Right? If it is 100 crore and above, but less than 250, crores. If it is 100 crores and above and it is less than 250 crores, then you can pay 120 lakhs. And if it is 250 crores and above, then you can pay 120 lakhs plus 0.01% of the excessive effective capital over and above 250 crores. Okay, this is the amount that you can pay. This is the amount you can pay after passing ordinary resolution. Passing ordinary resolution in case of this is mandatory. Okay, passing OR in this case is mandatory. And if you want to exceed the limits, okay, if the limits are getting exceeded, then in that case you can pass a special resolution. But even if you want to pay within the limit, then also you have to pass the ordinary resolution. If the limits are getting exceeded, then you can pass a special resolution. If any particular managerial personnel is appointed for part of the year, then these limits, anyway these limits are per annum, so you can do pro rata, that is you can do proportionate, right? Then if you are paying any remuneration, to a managerial person, if you are paying any remuneration to a managerial person who is working in a professional capacity, means he is not involved in day-to-day activities, but he is working in a professional capacity as an advisor, etc. But he is a managerial person, who is not having any interest in the company. Okay, he is not related to any promoters of the company in the last 2 years, and he is having good expertise knowledge. Okay, means he is a specific person whom we have kept in the company even during our bad times. Then if you want to pay any amount to him, even within the limits, if you want to, since he is a managerial person, you can pay. Okay, if you want to pay any amount to him, even within the limits, then also you have to pass a special resolution, because you have to give a justification to the shareholders that why such a person is still required in the company, even when the company is into losses. Okay, so you have to pass a special resolution even if you are paying any amount to him within the limits. And if the limits are exceeded, then to anyway we are required to pass a special resolution. Okay, then two more extra requirements here is, first of all, NRC or the board has to satisfy that yes, we are paying so and so amount. For both the cases, for A point as well as B point, NRC or the board has to give its approval before making the payment of the remuneration. And suppose if you have defaulted with bank, PFI, non-convertible debenture holders, or with the secured creditors, then in that case we have to take their approval also. Okay, we have to take their approval also. Then going on to the next one. Suppose if there are some special cases where you can pay remuneration in excess of the limits which were given in the section 2. In the last one, that is even more than the limits which were given, and that too without passing special resolution. Okay, that too without passing special resolution, you can pay more than the limits. In that there are specifically there are 3 important pointers there. First of all, if the company is a newly incorporated company, then for a period of 7 years. Okay, then for a period, if the company is into losses, obviously, if the company is into losses, then if it is a new company, then for the first 7 years, it can pay any amount more than the limits, even without passing a SR. Okay, or if it is a sick company and the BIFR has just approved the revival scheme, then for a period of 5 years from that day, you can pay any amount of remuneration more than the limits. Okay, and the last one, if a resolution plan has been approved by the NCLT under IBC, then from the date of approval for a period of 5 years, you can pay any amount. Okay, you can pay any amount without passing the special resolution. Or if suppose the BIFR has fixed the limit of your remuneration, then whatever amount the BIFR, that is the Board for Industrial and Financial Reconstruction, whatever amount it has fixed, that much amount we can pay. Okay, now here the auditor and the auditor or the company secretary has to give a certification that outsiders, or that no default, that the outsiders do not have any objection and no default has been done with the outsiders. So then only you can pay any amount more than the limit. Okay, those were the important pointers which we have taken from section number 3, because as it's not very important, so we have just covered the important pointers from there. Okay, section 4 is very, very simple. Section 4 simply says that these specific perquisites, these specific allowances which are paid to a managerial personnel, this is over and above the remuneration. Okay, this is over and above the remuneration that he is getting, means he will get remuneration, means he will get perquisites allowances, means he will get sitting fees for attending the board meetings, and then he is going to also get professional fees if he is rendering some other services in professional capacity, just like we took the example of doctor, right? Now, effective capital, the calculation of effective capital here is important, as you can get a numerical question on that. Just try to understand here, effective capital, how do we calculate effective capital? I have written a summary here on the right hand side. Effective capital will be your paid up share capital, but excluding your share application money. Share application money has to be subtracted. Okay, then plus all your reserves and surplus, plus your securities premium, plus your long-term loans which are repayable obviously after a period of 1 year. All those will be added first. Your investments will be subtracted, your accumulated losses will be subtracted, your preliminary expenses which are not written off, those will be subtracted, and whatever amount you get, that is nothing but your effective capital. Okay, but if your company is an investment company, then in that case you are not supposed to subtract. The investment, because in that case investment forms your stock. Okay, so this first point was very, very important in this important explanation, and that is what we have covered up here. Going on to the next one, that is section 5. Section 5 is again very, very simple. Suppose if there is a managerial personnel if there is a person who is a managerial personnel in 2 companies. Okay, if there is a particular person who is a managerial personnel in 2 companies, then he can receive remuneration from both the companies, but the total amount that he can receive from both the companies, that is higher of the amount eligible from any one of the company. Suppose if he is eligible to receive 1 crore from one company and 2 crores from another company, then he cannot receive 3 crore, but he can receive maximum 2 crore total from both the companies. This is the restriction which has been imposed by section 5, so as to ensure that a person is a managerial personnel in least possible companies. Okay. Now listen, going on to the further parts which are very, very simple. We have already completed part 1 of schedule 5. Part 1 of schedule 5 was the cases where we had to take CG's approval initially, which we had done. Okay, then part 2 of schedule 5 is what we have been doing till now. Okay, now comes your part 3. Part 3 is very simple. Part 3 says that whatever appointment and remuneration we are fixing for this particular managerial personnel, that has to be approved by the shareholders in the general meeting. That we already know. We had taken the ratification from the shareholders in the general meeting, and the auditor and the CS, they have to certify that all the requirements of remuneration clauses, appointment clauses have been fulfilled, and they have to file this certificate. With the ROC stating that yes, the company has fulfilled all the requirements. Okay, so this was a procedural part basically. Part 4 is again very simple. Part 4 says that central government, as usual, as we have been doing in many chapters of allied laws, that central government, if it wants, it can provide exemptions from any provisions to any particular company or to any class of companies. Okay, we have got a summary of this. If you can see it here. Part 1 was talking about those disqualification and the approval of CG which was required. Right? Part 2 has 5 sections in that. First section talks about the case where the company is having profits. Okay, second section talks about the case where the company is having inadequate profits or losses. Third section talks about the case where the person is receiving managerial remuneration when we are paying remuneration in special cases. Remember that incorporation 7 years, BIFR 5 years, IBC 5 years, those 3 cases. Right? Section 4 talks about perquisites and allowances. That it will be over and above. And section 5 talks about receiving remuneration from multiple companies, and in that case you can receive the higher of the above. This is given in section 5. Then coming on to part 3. Part 3 was talking about the procedure, that is appointment and remuneration will be approved by the shareholders, and then the auditor and the CS are also going to certify that all the requirements have been fulfilled. And the last part says that exemption can be provided by the central government. Exemption can be provided by the central government to any specific company or to specific classes of companies. Right? Going on to section number 198, as we have already referred section number 198 once, which was talking about whenever in section number 197 subsection 1, when we were calculating that remuneration as a percentage of net profit, 5%, 10%, 1%, 3%, that net profit will be calculated as per section number 198. Okay, one small conclusion that I can give you for section number 198. Okay, one small conclusion which I can give you for section number 198 is that all the revenue expenses will be allowed from the net profit. all the capital expenses or the non-business expenses, those will be added back. Basically, those will be disallowed. Okay, all the revenue incomes will be taxable and all the capital incomes will be excluded. After doing all those listed adjustments, you need not by heart this. After doing all those listed adjustments, whatever net profit you get, that net profit is your net profit under section number 198, which you are going to use for the purpose of section number 197. Okay. Going on to the next one, that is section number 199. Going on to the next section, that is section number 199. 199 says that suppose if the company has done any fraud, okay, or if the company has not complied with any provisions, and if someone has told the company, or if some regulator has told the company to restate its financial statements, this you have studied in your audit. If you are supposed to restate your financial statements, then in that case, suppose if any excessive remuneration was paid earlier, then we are going to recover such excessive remuneration. Okay, time period is not specified here, but we are going to recover that excessive remuneration from that particular director or that managerial person. Right? Now, next section, section number 200. Section number 200 is very simple, which says that company can fix, suppose if the company is not having profits or if the company is having inadequate profits, then the company can fix the remuneration, that how much remuneration should be paid to so and so person. Okay, how much remuneration should be paid to so and so person, which depends on financial position of the company. That depends on the qualifications of that managerial personnel or qualifications of that particular individual. His experience, what kind of experience is he having? Okay, it depends. How much is he a managerial personnel in some other company? Then we can pay him something less. Is he acting in some other capacity in our company? Then we can pay him something less. So depending upon these factors, company is going to fix the limit of remuneration in case the company is having insufficient profits or if the company is into loss. Okay, these are the factors which the company is considering while fixing the amount of remuneration. Going on to the next section, that is section number 201. 201 is referring to MR2. 201, section number 201 refers to form number MR2. Remember, in form number MR2, we were going and making an application. to the central government within a period of 90 days from the date when the board had approved the appointment of that particular managerial person. So they are telling that before you go and make an application to the central government, before that make sure that you have intimated the shareholders. That we are going to go and make an application to the CG, and plus you have to give a public notice in two newspapers. You are very much aware about it. One is your English language newspaper and the other one is your vernacular language newspaper. We have to give the notice in those newspapers that we are going to go and make an application to the CG, and only after that we can go and make an application to the CG in form number MR2 within a period of 90 days. Right? Next section, section number 202. Okay, next section number 202, which is an important section. Okay, now 202 talks about, last few sections left. Okay, now 202 talks about compensation for loss of office. Okay, it talks about compensation for loss of office in case of managerial personnel. It talks about compensation in case of loss of office in case of only to the managerial personnel. If the managerial personnel are losing their office, okay, if the managerial personnel are losing their office for any particular reason, because of any particular reason, then in that case they are eligible for compensation for loss of office, except for 6 reasons. And those 6 reasons are actually nothing but whenever the managerial personnel has done some default. Whenever the managerial personnel has done some default, then in that case he will not be eligible for compensation for loss of office. Okay, example, if suppose the company has been taken over by some other company, and we have been given the same position in the new company, but I say no, I don't want to go, then in that case I will not be eligible for any compensation for loss of office. If my company has been wounded up because of my mistake, okay, if I have to vacate my office because I have done some default as per section number 167, if say for example I only resign, I say I don't want to be in your company, then the company will say go, I will not pay you any compensation. Okay, if I have done some fraud or if there is a breach of trust, then in that case, no compensation. Or if I have done something because of my mistake only my office has gone, or my job has gone, or my position has gone, then in that case, did you observe in all the cases, there was a default of the managerial personnel only. If there is a default done by the managerial personnel, then he will not be eligible for compensation for loss of office. Otherwise, in all the other cases, he will be eligible. Ma'am, how much compensation to be paid? Ma'am, how much compensation to be paid? Whatever remuneration he could have earned if he was there in the office, if he would have been in the office for the remaining tenure or 3 years, whichever is shorter. Okay, so for how much period you have to pay him the remuneration? For the remaining tenure that would have been there in the company, or 3 years, whichever is shorter, for this much period, whatever amount of remuneration he would have been eligible for, that much amount of compensation can be paid. How do we calculate this particular remuneration? We have to take the average remuneration paid during the last 3 years. Okay, average remuneration paid during the last 3 years into this particular period. Okay, what period? Remaining tenure or 3 years, whichever is shorter. This is the maximum compensation for loss of office that can be paid as per the Companies Act. Okay, if suppose the compensation is still, now listen, this compensation has to be paid, no doubt in that. Now suppose if this compensation is payable, the company said that, okay, I will pay you in some time. But within a period of 12 months, the day when he left his office, within a period of 12 months, if winding up happened in the company, and if the company is not having sufficient amount, then in that case, the company can say, Tata bye-bye, I am not going to pay you the compensation. But provided winding up happens within a period of 12 months from the date when he left his office. Right? Now, suppose if the director or this managerial personnel, he has not done a fraud. It is not yet proved that he has done a fraud, but there is an allegation on him that maybe this particular managerial personnel was involved in this. Okay, maybe this managerial personnel was involved in this. Then in that case, it is at the discretion of the company whether to pay him the compensation or not. Okay, if basically, see, this is not a conviction, this is an allegation. Okay, on the basis of allegation, we can pay. Okay, if the company is, so confident, then the company can pay. But later on, if it is proved that this particular managerial personnel was involved in the fraud, then boss, this compensation cannot be recovered back. Okay, this compensation cannot be recovered back. This was decided in Bell versus Level Brothers case laws, that if later on it is proved that this particular managerial personnel was liable, then the paid compensation cannot be recovered back from him. So better is if there is any such allegation, then better is do not pay the compensation till the case is clear, right? Okay, but if at all the company has paid, then that compensation cannot be recovered. Also, now we have taken some point from the rules, relevant rules here, that if the company has done any default with the outsiders, maybe non-redemption of public deposit, non-redemption of debentures, or if there is any statutory dues pending, if there is any government dues pending, if any employee dues are pending, if you have done any default with the outsiders, then boss, you cannot pay any compensation for loss of office. Okay, first clear the dues of the outsiders, then only you will be eligible to pay the compensation for loss of office. Okay, and just remember 202, that section number 202 was applicable only for managerial personnel, not for other directors. It was applicable only for the managerial personnel. Okay, going on to the next section again, section number 203. Some points are really very, very important. Let's cover the most important pointers. Okay, from exam point of view, let's cover the most important pointers for the purpose of section number 203. Section number 203 talks about appointment of KMP. Okay, it talks about appointment of KMP, key managerial personnel. First of all, who all comes under the term called as KMP? First of all, MP comes. MP means MD, Managing Director or CEO. If there is no MD, then manager will come. And if MD, manager, none of them are there, then in that case, a whole-time director. Okay, at least this person is going to be there in the KMP. And company secretary, in-house company secretary has to be there in the company whole time. All these are to be whole time. And a CFO should be there in the company. Then in that case, we will say that yes, the company is having a whole-time KMP. Okay, now which companies are required? Which companies are required to appoint or to keep a whole-time KMP? Every listed company is going to come up here. Every listed company is going to come up here. And every other unlisted public company whose paid up share capital is at least rupees 10 crore as per the latest audited financial statement. Every other public company whose paid up share capital is at least rupees 10 crore. These companies, okay, either if that company is a listed company, then it has to follow, or if it's not a listed company but it's a public company and its paid up share capital is at least rupees 10 crore, then it has to appoint a whole time KMP mandatorily. Okay, then there was an amendment here. That, see here in the above, your requirement for CS was applicable. Requirement for CS was applicable because that was included in your whole time KMP. Now similarly, every private company whose paid up share capital is at least rupees 10 crore, every private company, even that company has to keep a whole time CS. Okay, full KMP is not required, but it has to keep a whole time CS in the company. Okay, that was the amendment which had happened here. The limit was increased there. Now, if there is a particular company, just try to understand these small pointers now. If there is a particular company, in a particular company, same person cannot be appointed. As MD as well as chairperson. Okay, because otherwise too many roles, too many responsibilities come on the same person. MD and chairperson cannot be the same person, except if AOA says okay, no problem, or if the company is into single line of operation, then the responsibilities, roles, etc. would be less. So in that case, it would be allowed. Otherwise, MD and chairperson cannot be the same person. Okay, another case where MD and chairperson can be the same person is if it is a big public company. Okay, if it is a big public company, and for every business, if it has got a different CEO, then in that case, MD and chairperson can be the same person. Okay. Then whenever whole time KMP is appointed, he is appointed by the board resolution. If there is a vacancy, in the place of whole time KMP, then that vacancy will be filled by the board of directors within a period of 6 months. From the date of vacancy, right? This is what we have studied here in the 4th subsection. If there is a whole time KMP, if there is a particular person who is a whole time KMP in a company, then he cannot be a whole time KMP in any other company except its subsidiary company. He can be other director in the other company. There's no problem in that. But he cannot be a whole time person in the other company. Okay, he cannot be a whole time director in whole time KMP in some other company except for its subsidiary company. Right? Okay. Then going on to the next one, coming on to MD point. A particular person can be a MD in maximum 2 companies. Okay, I can be a MD in maximum 2 companies. That is in one company and one more another company. Okay, but when I am going to be appointed in the second company, then we have to pass a board resolution by physically calling a meeting, not by circulation. Okay, not by circulation. The directors cannot sit at home and vote. We have to physically call for a board meeting. And whoever are present, okay, all the directors who are present, all of them should say yes. Then only I can be appointed as a MD in the second company. Right? All these pointers about the KMP, all these pointers about the MP in the KMP part, these are not applicable to a government company. Don't forget that. This subsection 4A is very, very important. Okay, this exception is very, very important. That is this managerial personnel part for government company is not applicable. Going on to the next section, section number 204. Section number 204 talks about secretarial audit. Secretarial audit done by a company secretary. Some companies, some prescribed companies are required to get secretarial audit done from a company secretary in practice. Not this in-house CS, but by a company secretary in practice, we have to get the secretarial audit done from that particular person, and that person is going to submit the report in form number MR3. Okay, that particular person is going to submit the report in form number MR3. He is going to basically submit a report in a particular format, mainly about the compliances. Whenever he is doing this particular audit, At that time, he will require certain information from the company. The company is required to provide this information. The company is required to provide this particular information to the CS mandatorily. Whatever CS writes in his report, whatever CS writes, whatever qualifications, etc. he gives in his report, on that the board has to give his comment. Okay, the board has to give its comment on that. That is again mandatory. And if there is any default which is done either by the CS, any default which is done by the company, any default which is done by the officer, then there is a range of punishment that is applicable ranging between rupees 1 lakh to 5. Okay, now who is required to get the secretarial audit done? We have an amendment also coming up here. First of all, every listed company that is going to come anyway. Okay, every listed company is going to come up there. Then in case of prescribed companies, then in case of other public companies, unlisted companies, if its paid up share capital is at least rupees 50 crore or its turnover is at least rupees 250 crore or any other company whose outstanding loans, borrowings, etc. from banks PFI is at least rupees 100 crore. Then in that case, even such a company, such huge loans it is having, such a company is also required to get a secretarial audit done from a company secretary in practice in form number MR. Okay, means the report will be submitted in form number MR. 205 is a one-time read section which was mainly talking about the functions of the company secretary in general. What are his functions? Okay, example, conducting meetings, convening meetings. Okay, then preparing the minutes, making sure that all the compliances have been followed. Okay, he acts as a compliance officer for the listed companies as studied in the LODR provisions. He advises the board about all the compliances that the company should follow. He has to follow all the secretarial standards. He has to advise the board. Whenever any approvals are supposed to be taken from the CG, just like we saw MR2 form. Okay, whenever any approvals are supposed to be taken by board resolution, whenever any approvals are supposed to be taken from any government authority, all these works are done by the company secretary. Okay, for that purpose only we appoint a company secretary. And most important point, suppose if you have to write this point somewhere about the functions of company secretary, one thing is very, very important there is, whenever the company secretary is acting, he has to comply with the secretarial standards. These secretarial standards are issued by the ICSI, that is the Institute of Company Secretaries of India, and it will be approved, and these standards are approved by the central government. Right? These were the most important functions. These were the most important functions of the company secretary. And at the end, we have a case law. That is the Bell versus Lever Brothers, which we have already considered. Now, one conclusion from this we have considered is, if suppose compensation on the basis of allegation, okay, compensation on the basis of allegations, if it has been paid to any person, then that cannot be recovered back in any circumstance. That particular compensation cannot be recovered back. And one more thing that they are telling here is, if suppose any particular person has done some breach, okay, if suppose any particular person has done some breach of any of his obligation, he has done some mistake and he knows that he has done some mistake, then he is not legally bound to suo moto go and disclose that I have done so and so mistake. Okay, he is not legally bound to disclose that. Okay, this is what was concluded in Bell versus Lever Brothers. And this was all about all the important pointers from exam point of view, which we have covered in this revision. I hope you are very, very clear with the provisions.